in equity land, we're mostly pricing in a soft landing circumstance right now.
It's really not a bad economy, it's a good economy, and I don't think it calls for any drastic Fed action.
I don't really care what they do next week. What I care about is how the markets react.
Right now, investors are on edge, and so far it's been a good year, so you could see some people continue to take profits.
For the equity market, volatility is going to dominate because from here, so much good economic news is priced in.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now with equity futures on the S&P 500 slightly positive coming into Thursday on a 3-day winning streak through Wednesday on the S&P 500. Thank you, NVIDIA. It's a 3-day rally with plenty of volatility. These are your scores, and this is your day ahead. A little bit later on this morning, 8:15 Eastern Time, an ECB interest rate decision. Then at 8:30, 2 doses of data, PPI and Bramo initial jobless claims.
How much are we kind of taking the pressure off initial jobless claims? Because now the question isn't whether we go 25 or 50, it's we're going to go 25. And just how much can we let the equity market rip in the face of a soft landing in tandem with rate cuts? I mean, it seems like people suddenly have breathed a breath of fresh air. Yesterday, we thought we weren't going to get resolution. We did. And now everyone's feeling golden again.
Thank you, NVIDIA. You want to talk about NVIDIA? The NVIDIA CEO at a conference comes out and says what? Things are so good, demand is so great that we've got tension between our customers and our ability to supply them.
People get emotional about deliveries. If they can't get their deliveries on time, it is something that is visceral and goes to their core because they need those chips so badly. So NVIDIA shares up more than 8%. You've got about 13.7% rally so far this week alone. I mean, you just talk about how volatile things are. This is a massive $1 trillion stock, and you're seeing it bounce around by 8% on any given day because people get emotional.
$200 billion of market cap, just like that in a single session. We're getting used to that. Should we be getting used to that? Need to talk about crude as well. Brent crude bouncing back by 1.8%. WTI still in the high 60s at 68.58. We're up by 1.9%. We heard from the IEA confirming some of the fears that a lot of you have about oil demand. Slowing growth sharply. The slowest rate of growth since the pandemic for global oil demand, and that's a problem.
That is a problem. We've seen this reflected in the prices. Now the IEA coming out with their report about the future of what this market looks like. So not exactly this is a surprise given what people have been talking about. What I find so interesting is the IEA was also leaning into what we heard from Vitol, which is the fact that in China, gasoline uptick is really starting to wane because of everyone just going out and buying EVs, and they have very cheap EVs. So that is one of the issues that is happening, this transition, but people are just not consuming as much.
So we get an ECB rate decision a little bit later this morning. We get a set of forecasts as well. I find the compare and contrast between Europe and the United States to be quite amazing. The fact that we're having this discussion about going 25 or 50 at the Federal Reserve, with inflation essentially where it is over in Europe, here in the United States, and the growth profile in America seemingly so much more robust here in America versus Europe. Why isn't there a conversation about cutting 50 basis points to the ECB later this morning?
I couldn't agree more. I mean, this has been my big question. Why are we not talking about the ECB cutting much more aggressively than the Federal Reserve, given the fact that if they had a dual mandate, which evidently they don't, they would be looking very much at the growth picture. They'd be looking at Germany and they'd be saying, whoa, just a kid in just a second here. We want to cut a little bit more aggressively. How much is this just because they already telegraphed something and they have to kind of stick with it? And that's the reason why today's going to be very interesting. How much do they telegraph going forward? That they are open to bigger cuts, taking a cue from Jay Powell over in Jackson Hole.
Well, I think essentially you nailed it. There's a structural issue. It's a single mandate central bank. It's inflation. If they had a dual mandate, maybe we'd get a different picture. I also think it's historical. You've got this German influence on the central bank still, where they're scarred by the inflation of decades ago and worried about the inflation profile. The backdrop in Europe still currently in 2024.
Here's the irony of that. Germany has a disinflation or deflation problem. The inflation right now is in the peripheral regions where they're getting so much tourism that they don't want anymore, that they actually are seeing that kind of growth. So to me, I wonder how much that institutional sort of disdain for inflation goes away, given the growth picture that's quite dire.
Germany's got a lot of things to say at the moment. We'll revisit some of that a little bit later this hour. From New York City, welcome to the programme. The broader price action looks like this. Cross-asset, equity futures positive by 0.1% on the S&P 500. In the bond market, what a trip. We talked about the round trip on on Nvidia all over the place in the bond market in yesterday's session. The 10-year up by 2 basis points to 367.40. Lisa, what did you make of that? Initially, the bond market move in the morning and then in the afternoon, all over the place.
I make the auctions. That's what it had to come down to, essentially. And you can laugh, but it actually was very much the auctions. The auctions have been very strong this week. And yesterday we saw a sell-off in 10-year yields, and then you saw people just rush to buy the debt at that 1 p.m. auction. It just highlights how that can trigger some of the feeling that maybe there is this demand and there's a sense that we are going back to a new normal that looks a lot like the old normal. That was sort of what I attribute, and then people kind of played around and the algos got involved. But today we've got a $22 billion 30-year notes being sold, and maybe you'll see a similar round trip as a result.
I'm reflecting on something Mike Wilson and Morgan Stanley told us on this programme yesterday, that we're done with the inflation story. And I just feel like the bond market and bond investors are very much done with the inflation story. What I mentioned yesterday was that equity investors are worried maybe the Federal Reserve might not be. And that's why this conversation has steered away from 50 and back towards 25 for next week.
That's what I thought was interesting yesterday. You saw a reinversion of the yield curve, this sort of wondering whether if the Fed does hold off on cutting rates so aggressively, whether you could start to think about maybe an inflation issue that was stickier. Maybe you're looking at a better economy. Look, honestly, people don't know. They're basically spitballing, and that's basically what we saw yesterday with the fact that you're seeing $1 trillion stock trade like a penny stock. So, you know, for us to really give real much narrative to this, well, good luck.
The base case shifted at Citi. Andrew Hollenhorst shifting away from 50, now looking for 25, a 25 basis point cut, the Federal Reserve at next week's meeting. Here's the lineup for this hour. Coming up, we'll catch up with Sharon of Goldman Sachs as big tech stages a big comeback. Javier Blas of Bloomberg Opinion as China weighs on crude demand. And Rob Waldner of Invesco ahead of a string of central bank decisions kicking off a little bit later on this morning. We begin with our top story. Big tech fueling a rebound in global equities led by, guess who? Nvidia. Sharon of Goldman Sachs writing, today's technology sector reflects rational exuberance, justified by strong fundamentals and earnings growth that has surpassed that of the broader market. Sharon joins us now for more. Sharon, as always, welcome to the programme. Let's talk about how rational some of those $200 billion single-day moves on a single stock actually are. What do you make of some of the volatility we're seeing at the single name level, Sharon? Some of these massive moves from day to day.
Yeah, I mean, it does show that the market overall is a little bit vulnerable. You have a market where some of the very biggest companies are this volatile, losing and gaining in individual days like this. I do think this is a reflection of all the uncertainty we have at the moment. Uncertainty over interest rates, policy, fiscal policy, political outcomes for the election, just a lot of uncertainty, which the market is just finding difficult to price.
You're in Europe, and the uncertainty right now around Europe is actually less than a lot of people would expect it to be in terms of how big the rate cut will be at the European Central Bank later this morning. Do you think that there will be a time later this year we'll be talking about an outsized cut from the ECB in response to outsized weakness, particularly with Germany?
Yeah, Germany has been super weak. I completely agree. The second quarter saw a contraction in GDP. The manufacturing sector is clearly in recession. It has been for some time. There's a talk about now more sort of German layoffs or unemployment. I think it's absolutely clear that Germany is very, very weak. But it's not just Germany, of course, making up the euro area. Other countries have been a little bit stronger than Germany, and the ECB is looking at that entire picture. Plus, there's some parts of inflation that have been quite sticky, like services inflation. We think the ECB will go a quarter point. We think that they're unlikely to try and go faster than that at the moment. But they next year, I think they might go every meeting, just reflecting, as you point out, that growth has clearly weakened.
When you said there's a lot of uncertainty and it's hard to understand exactly some of the patterns in markets right now, how do you explain the DAX being up 9% in the face of outsized weakness in Germany and a German economy that's facing every structural headwind you could possibly imagine, from China to the auto sector to geopolitical risk?
Absolutely. And I've been asked this question quite a lot by our clients, by our investors. And the DAX have done perfectly fine this year. It's not been a super outperformer versus other indices, but it's, you know, kept pace, let's say, with other European indices, even though German economy has been clearly very weak. But the DAX isn't really a reflection of the German economy. The biggest companies, it's almost like there's a magnificent 4 or 5 companies in the DAX. SAP, for example, is 15% of the index. It's done well this year. You've got other big caps, Rheinmetall, for example, in defence, which have done well. You've got Siemens Energy. These are really big cap companies which aren't necessarily super exposed to the German economy overall. whereas some of the auto manufacturers are now actually quite smaller parts. Chemicals is a smaller part of the index. I'm not saying it's not sensitive at all to German economic growth or to China growth, which has also been weak. But I think it's a reflection of just different stock makeup. The MDAX, the mid-cap index, that has just been much weaker this year, and I think is more of a reflection of that weak German economic outcome.
Sharon, when you look at the German economy, though, Lisa named a number of issues that they're dealing with: slowing manufacturing, exposure to China, more tariffs. Which one of these is what you're most concerned about for some of those players that you say are less exposed to the German economy, but they're still exposed to what's going on internationally?
For sure. And you worry, I mean, almost every stock to some extent has got some cyclicality. So if growth does slow, that's generally bad news. That being all said, that if interest rates are coming down, that provides a little bit of an offset as well. The market will start to price in at some point an economic recovery. But, you know, I agree. I think probably the most worrisome thing for Germany is not so much the flat German economic performance we've seen in the last few quarters. It's just the weakness in China. And the fact that China domestic demand has been weak, while China exports, which is effectively competition for the German exporters, have been so incredibly strong. And that combination, I think, is quite painful.
Is Germany the worst when it comes to that exposure to China across Europe?
Definitely. I mean, European companies generally do have a high amount of China exposure, probably about 10% on average for the Stock 600, the broad European index. So there's quite a lot of China exposure generally. I mean, luxury goods, for example, which aren't big in the German market, they have a lot of China exposure. So it's certainly not just Germany. But Germany does have a lot of exposure via the auto companies, for example, via some of the other industrials. And that exposure, I think, is not just in terms of weaker domestic demand in China. It's also the fact that China is exporting at lower prices into Germany and to other markets that Germany is competing with China in.
Sharon, you wrote a brilliant note on this, and I suggest people should reach out to you directly to get the full note. Just the flavour of it, the title: German stocks are breaking free from the economy. Now, Sharon, I wonder if the earnings profile is going to improve because of that and some of the dynamics that you've listed. Can you walk us through how Europe and German equities in the market are attracting flows? Because we're so familiar with the problem. Is the money actually coming in?
Do you mean are people buying European stocks?
Precisely.
Generally, yeah. People have been quite cautious. I was in New York last week and talking about Europe generally, and you know, Europe has underperformed the US for a long time. It's underperformed US equities year to date as well. That being said, not by as much as perhaps you'd think, given that weaker German economic outcome that we've just talked about. And I think that is a reflection of the fact that some of the biggest companies are actually incredibly high-quality growth companies as well. Are investors buying it? To some extent, yes. There is a little bit more of a tick-up in interest in Europe. I think also, even in the UK, where the UK market proved to be very defensive in the big sell-off that we saw in August, also European companies are buying back shares. So you don't necessarily need a huge amount of investor flows if companies themselves are doing the buying for you by buying back their own shares. So dividends are high across Europe, cash flow is good, which is supporting that, buying back shares, and a little bit of increased investor interest as well.
Sharon, before we let you go, Morgan Stanley just cut its expectation for the euro to potentially parity as a result of some of the weakness. Goldman Sachs, your own firm, just recently cut the ECB terminal rate expectation to about 2%. How concerned are you about the weakness of the euro as some headwind to the call that you have?
Not super concerned. So if you're looking at European companies, in some ways the euro coming down should be helpful. It means that you become more competitive. So if the euro does come down, it's not in our forecast that it would, but that would help Europe to become more competitive. But I kind of get your point. You're basically saying that if you're a global investor, why would you invest in Europe if you're going to lose it on the currency if the currency starts coming down? It's not our view that it will, but it does put off some global investors that tend to invest in Europe on an un-currency hedge basis. So I think if the fall in the euro is a reflection of doom and gloom on Europe and the European economy really is much, much weaker than we expect, then yes, I would see it as damaging. If it's just a modest decline and it makes Europe a little bit more competitive globally, then I don't think it's all that damaging.
Hey, Sharon, appreciate your time, as always. Sharon Bell there of Goldman Sachs out of London with a fantastic note, going through a list of reasons on ultimately why we are so cautious on Europe around the world at the moment. Manufacturing issues, problems with China, trade, energy security, unpredictable politics, put it all together. It's been a big reason why people haven't been buying Europe for a long, long time.
Which is the reason why, I guess the one question is, why should they start now? Right? I mean, is it going to be really rate cuts by the ECB? Is it going to be optimism about specific companies that are somehow divorced from the overall economy? It's the reason why you've had lackluster kinds of performance. At the same time, how many people around this table come on and say, we're looking to diversify outside of the U.S.? This is the problem. To where? And how much can you get ambitious and excited about the opportunities there?
Germany's been very outspoken in the last 24 hours. Annmarie, have you noticed that? How outspoken Germany has been? A misplaced sense of arrogance, maybe, considering what's happening domestically at the moment?
They have been very outspoken on the VW story about what is going on in terms of energy transition. And then the most outspoken has obviously been on what's going on with Commerzbank and how potentially the unions would prefer a tie-up with the French over the Italian. Honestly, pretty rude.
This is 2024. It is not 2012. The idea back in 2012 that Germany could lord it over Europe and tell the Europeans what to do, to have this attitude 12 months later in 2024, I find unbelievable. This quote from the Labour representative who sits on the German Bank Supervisory Board to a French business daily newspaper: we understand each other better with the French in terms of industrial policy on how to run a bank than with, say, the bankers in Milan. If you're at a dance party and no one is asking you to dance, you don't just get to stand around and say, we're waiting for someone hotter to walk in the room. No one's coming up to you. Take a look in the mirror. That's what needs to happen. I'm deadly serious.
Germany.
The German industrial problems right now are absolutely massive. It was really interesting to see Donald Trump went after Germany just a little bit in the debate earlier this week. And the Germans were tweeting about it as if the energy security issues in Germany weren't a problem, that things were going to be OK. And, oh, by the way, we don't eat cats and dogs. You know, throwing around that kind of snark on the international stage, I don't think it's helpful at all when Europe has got some major issues.
Yeah, it was pretty remarkable seeing a foreign office come out and have a tweet about an election for their closest ally that's also sending them a lot of liquefied natural gas and basically bailed them out for their mistake of enslaving themselves to cheap Russian energy, which is why they had a manufacturing base, which we now see is in decline. And also, Trump's point was Germany was abandoning fossil fuels at a time when they shouldn't have been, because of what was going on geopolitically.
I'm looking forward to your book, Germany and Their Misplaced Sense of Arrogance, and the U.S. and the Privilege of Acting Recklessly.
Sure.
That can be your title.
Europe has changed a lot in the last decade, and there is a big problem, child.
And
it's not Italy and Spain like it used to be. It's other nations now. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Morning, Danny.
Good morning, John. 7&I shares jumped after Couche-Tard said it would be discussing a higher bid for the company. People familiar said that in order to get 7&I to enter negotiations, the bids would need to be significantly higher than what they initially proposed. That was $14.86 a share. The FT is also reporting that the Japanese convenience store operator appointed Nomura to advise on that takeover bid. Atlanta Fed President Raphael Bostic violated the central bank's rules around financial disclosure and trading activity. The Fed's independent inspector general said that there was no evidence that Bostic made trades based on confidential information or acted on financial conflicts of interest. The trades were handled by third parties, and neither Bostic nor his personal advisors directed specific trades. People familiar say OpenAI is in talks to raise another $6.5 billion in equity financing at around a valuation of $150 billion. That's a significant jump from earlier in the year when the company's tender offer put it at $86 billion. That now puts OpenAI in the top 100 most valuable companies. OpenAI is also reportedly in talks to raise $5 billion in debt from banks in the form of a revolving credit facility. That's your brief. John.
Hey, Danny, thank you. More from Danny in 30 minutes' time. Up next on the programme, debating a rematch.
We won the debate according to every poll, every single poll. I think that, are we going to do a rematch? I just don't know.
That conversation just around the corner, live from New York City this morning. Good morning. Three-day winning streak on the S&P 500, just a little bit firmer at the moment, looking to make it day 4. Equity futures on the S&P positive by 0.1%. Under surveillance this morning, debating a rematch.
When a fighter has a bad fight, gets knocked out or loses the fight, the first thing he says is, we want a rematch. So we won the debate according to every poll, every single poll. I think That are we going to do a rematch? I just don't know. But we'll think about it. I would do NBC. I'd do Fox too. I'd do Fox too. But right now we have to determine whether or not we even want to do it.
Well, the numbers in round one were absolutely massive. Tuesday's debate pulling in a huge audience of more than 67 million viewers, topping the turnout for Trump's debate with Biden in June by over 30%. Early polls showing voters picking Harris as the clear winner, with both candidates yet to agree on a rematch. Bloomberg's Mike Shepard joins us now for more. Shep, walk us through the path forward from here. The next 2 months of campaigning, do we get another debate?
Well, it's a great question, John, and I think we're looking forward to seeing how this gets answered, because the debate on Tuesday night really answered a lot of questions about how the two candidates would comport themselves against one another and what we would see from Kamala Harris in particular. She used the stage on Tuesday night to take a more prosecutorial approach toward Trump, using his own words as president, his own actions as president, and everything he's done since leaving office to try to undermine him as an opponent and candidate. Trump, on the other hand, came in less prepared, and he was on the defensive for most of the debate, and that made it hard for him to do the main thing he had to do on Tuesday, and that was define Harris and really hang more of the Biden administration policy failures on her. And so for Trump to decide to do another debate, he has to take a very different approach going into it if that were to happen.
Shep, let's talk about the rest of the 48 hours. We know Kamala Harris is going to North Carolina. Democrats really view North Carolina potentially in play this year. But Trump's going to California. I understand why he's going there for fundraising, but why is he giving a press conference in a very blue state?
Well, Trump is looking for any sort of media that he can get at this point to make up for some of the struggles that he had on Tuesday before an audience of 67 million people. And he will do that. He would do that news conference in New York just as well. He will also be using that West Coast swing, Annmarie, to visit Arizona and Nevada, which are two critical states. So he'll be out there looking for money, looking for that attention from the public from a wider stage, and then also visiting these swing states. But keep in mind, these news conferences that the former president has given, especially since leaving office, have not yielded the same kind of viewership and results that he did, for example, at the beginning of his term as president.
Have we seen any impact yet, Shep, as well, of the Taylor Swift endorsement?
Well, so far, what we have noticed is that the vote.gov website, which is an official federal government platform that directs voters to voter registration links in all 50 states, there was, from the link on her Instagram post endorsing Kamala Harris, more than 300,000 queries to vote.gov. That doesn't mean people register, but it does signal the interest that voters, that Swifties, she sent this out to 283 million followers on Instagram. And we do know that Taylor Swift has an enthusiastic following. It skews young. But remember, even the kids who may be going to these concerts, even if some of them might not be old enough to vote, they have parents who take them to those concerts and who are bought into, the Taylor Swift machine. And also this signals that there may be some organizational might behind it too, because the Swift movement also has lots of clubs, and the kids and fans really talk to each other and communicate to each other. And it's also a voting demographic that both Republicans and Democrats in particular are looking for.
I think Mike's suggesting the kids are about to bully the parents. Mike Shepard, thank you. On the Swift effect in a big race and a campaigning over the next 2 months. 67 million. That's a ton. The most watched debate ever? These are the numbers. 84 million. The first one between Trump and Hillary Clinton back in 2016. Yeah. That was pay-per-view. Real box office.
Yeah, this was pretty close. And what's interesting to me is that this was actually, I think, 30% more than the people who watched Biden versus Trump, although in the sort of repeated versions, maybe the numbers climbed quite a bit.
Yeah. Let's just say people are more interested now than perhaps they were a few months ago. Equity futures right now on the S&P positive by 0.1%. Coming up on this programme, we'll catch up with Javier Blas with Brent crude trading around $70 a barrel. From New York, this is Bloomberg. Three-day winning streak on the S&P 500. Equities positive by 0.1% this morning. Looking to make it day 4 on the Nasdaq, up by, let's call it 0.1%. The Nasdaq 100 having its best day since mid-August in yesterday's session. Nvidia helping the day with the best day since July on a single name that posted a gain of more than $200 billion US. Phenomenal.
Because ultimately, people are getting emotional over the deliveries of chips. They are very tense about making sure that they get in the right number. This was at a Goldman Sachs conference out west yesterday. The NVIDIA CEO is talking about the emotionalness of getting deliveries. It just points to sort of, I don't want to say the sort of random increase or decrease in stock prices, but it feels like it doesn't take much for stocks to really surge or fall dramatically on pretty massive names.
He has Chairman Powell-like power over financial markets.
Well
I don't think that's an over-exaggeration. He really does. He can come out and speak and the whole thing turns around, and we saw that in yesterday's session. Let's turn to the bond market. Yesterday, the 10-year posting a gain on a yield for the first time in September. But that gain in the end, at the end of the session, Lisa, only up by a single basis point, and the range up from anywhere from 4 and down from anywhere from 4. And the two-year range was all over the place as well. Mohamed El-Erian is going to join us in 30 minutes' time, and he's got a lot to say about the intraday volatility in the bond market.
Does it create greater degree of fragility in the financial market at a time where even the benchmark rate is so uncertain? Yesterday, there was a round-trip feeling, a question around how much the Fed could cut, how much they were willing to cut, and then also how much demand there was on the other side for longer-term bonds. The fact that the auctions have gone off so well this week really highlights that maybe the mood has shifted and people think inflation truly is a fight that is already over, and they are willing to go in U.S. debt in a way that they were not just a couple months ago.
There's just a massive bias to buy. It's something that Ian Lingen of BMO has repeated over the last month or so. Ian Lingen writing just yesterday, going into jobless claims. I think these numbers will be of interest to many of you. The number of weekly filers for unemployment benefits has stabilised recently, with the 4-week moving average down to 230k and the lowest since the beginning of the summer. Things have really stabilised in the labour market on that very specific data point over the last few months.
Which is the reason why people have reduced some of the emphasis on it. A key question, though, and we keep repeating this, and not to be talking conspiracy theories, but some people are wondering about the response rates of these. The response rates to these surveys have gone down dramatically since the pandemic. How accurate can they be at a time when people are hinged on every data point to understand the trajectory of the economy over a longer term? It's sort of the reason why people aren't completely complacent out there.
Jobless claims should be giving you a pretty clean read on things. That number comes out in 2 hours' time, together with PPI. The other thing that comes out a little bit later this morning at 8:15 Eastern Time, an ECB rate decision. So let's check out the euro. The scores look like this against the dollar. 110.19, positive by 0.1%. Some headlines coming from Morgan Stanley in the last few days suggesting that we could get down back towards parity. Now, we are all but guaranteed a 25 basis point rate cut later on, according to many of the estimates on the street from the ECB. We've been asking a question, given the growth backdrop, the profile at the moment, why are we having a conversation about 50 in America and not having that conversation in Europe, in Frankfurt, Germany?
And you identified it. How much is this because it is a single mandate central bank where they're focused completely on inflation versus the dual mandate of the Federal Reserve where they're also focused on the labor market? And how much is it just institutional disagreement and the sense that you're not getting all countries agreeing in Europe on exactly what the trajectory should be? That said, a lot of people are really curious to see if the ECB puts out something that indicates that they're ready to go faster, and maybe consecutive meetings starting as soon as now, at a time when a lot of people are saying disinflation and deflation is a bigger risk again.
Looking for some fresh guidance from President Lagarde later on this morning. That news conference at 8:45 Eastern Time. And looking for some new forecasts a little bit later on this morning as well. Euro dollar 110.18. Under surveillance, NVIDIA CEO Jensen Huang saying the scramble for a limited amount of supply of chips has frustrated some customers and raised tensions. His comments coming as NVIDIA leads a tech-fueled rebound in global equities. NVIDIA's up again this morning by 0.6%.
Yeah, it makes me feel a little bit unclear on how much some of these massive stocks can really move on what. What did we learn? We've known this. We've known that there's been a real huge demand for some of these chips. This isn't news. Why should the shares be up more than 13% so far this week? Is this just a buy the dip moment? And the more that there is a buy the dip moment, how much conviction can we have that those longs haven't been washed out and that we haven't seen a real reset in some of these equity markets?
I hate to be the Debbie Downer on NVIDIA, but he was also asked about the geopolitical concerns. They are so heavily relied on these chips that, yes, they make and design themselves, but they're manufactured by TSMC. There's no risk when you look at this stock, that people are really trying to weigh in some of these geopolitical concerns. At the same time, the Financial Times this morning, front page, talking about SEALs Team 6.
Yep.
For over a year, has been training on how they could help Taiwan if there was a Chinese invasion. So I just don't think any of that's reflected in the stock price.
So there are multiple dimensions to that line. That is one. Here's another. The market ran with the idea that this was all about demand, things are great, buy the stock. I wonder how much of that was a nod towards some of the regulatory problems that are starting to come to the surface around how some of these chips are being supplied to certain customers, and whether actually he was giving us a little bit of insight into the relationship with customers and maybe some of the complaints that are being made at the regulatory level down in Washington, D.C.
The sense that maybe they're worried that they're actually not going to be allowed to sell some of the chips or provide them, and this sort of concern about getting it ahead of some of the regulatory changes to make sure that that's the case. Look, they're going to be in the crosshairs, but the bottom line is the fact that the demand is so strong, it means that it's going to be hard for them to just
you remember
fall
some of the allegations against the company, but they were giving preferential treatment to some companies, telling some companies that if they didn't deal just with them and dealt with other people, they couldn't have the chips from them. I just wonder whether that's a point of tension overall. When he's talking about the relationship, what are we really talking about here? Is there something else going on?
Or is he basically saying to regulators, hey, people want our chips so badly, we don't have to play those games. And they're just so desperate to get them that, you know, these are the conversations that we have. Either way, people just said buy the stock.
It's a nod to everyone. And then they bought the stock. So Lisa's right. Let's turn to VW. Volkswagen chairman urging the European Union to alter its emissions targets and provide clarity to the car industry. His comments coming as the company makes a big cost-cutting push, scrapping job projections for auto workers in Germany after last week warning it may have to shut plants there for the first time in the company's 87-year history. Mario Draghi, on this ECB day, the former ECB president earlier this week warning the Europeans that their own regulations are killing European companies.
Well, what was fascinating here is this line that I think we have been talking about literally for months. The Germans, it feels like they're waking up to. Politicians have given the industry targets without the necessary infrastructure being available and without considering whether customers are along for the ride. The demand is not there, but the policymakers basically have told them, you have no choice, you have to get there.
How many times have we said America innovates, China replicates, and Europe regulates? Clearly, Mario Draghi wants to do something about that.
Yeah, although does he have any cooperation from Germany? And that's going to be the key question. I mean, again, it's sort of the curse of being a multifaceted region that has a number of independent governments.
That's the latest on VW. Here's the latest on space. Look out for some pretty stellar pictures coming in the next couple of minutes or so. A SpaceX crew of 4 astronauts making history this morning, getting ready to perform the first commercial spacewalk as part of the Polaris Dawn mission. The entire process for the extravehicular activity taking about 2 hours. Crew members Jared Isaacman and Sarah Gillis will exit the Crew Dragon capsule sequentially for about 15 to 20 minutes each. That's set to commence in the next 2 minutes or so.
Yeah, well, I can just say I went down a rabbit hole this morning. $12 million on average for a spacesuit from NASA.
Is that how much?
That's how much it is. $3.5 billion to include all-inclusive with the maintenance, et cetera. So this is a private venture. I'm curious about the scientific aspect of this. There is none. But there is a sense of, does this really pave the way to potentially more commercial exploration, or even, frankly, SpaceX showing that it can rival NASA at a time when there's real questions about the ability for the U.S. to continue to support NASA.
When that walk begins, we'll bring some of those pictures to you, so look out for that in the next 5-10 minutes or so. Elsewhere, the IEA saying in its monthly report that global oil demand growth is slowing sharply as China's economy continues to cool, pushing prices to a 3-year low. World consumption increased by 800,000 barrels a day in the first half of the year, the lowest rate since oil demand crashed during the 2020 pandemic. Following this closely, a good friend of ours, one of the very best, Javier Blas of Bloomberg Opinion. Javier, wonderful to catch up with you, sir. A big takeaway for us on crude in the last few days is just how bearish things have become and how quickly things have become bearish. Javier, what's behind the bearish noise that we hear from the sell side and the buy side alike in the last few days?
Well, I think that there are a number of elements. One is certainly that demand for oil is slowing down. But I think that the more structural question has been that OPEC plus Saudi Arabia have kept oil prices too high for too long, incentivizing every rival. Production from the United States, Canada, Brazil, Guyana is booming, and that's overwhelming the market, and it's going to continue overwhelming the market in 2025, just at a time where many of the OPEC plus members want to produce more. That's what is creating the big risk of a glut in 2025 that has driven prices sharply down.
I was struck by the IEA report, not in the fact that it had a pretty bearish tone to it, but the why behind it. And Annmarie mentioned this earlier. It was in part because of uptick in EV adoption, as well as just what they see as a peak in oil demand coming very soon. How much, Javier, is this bearish in the overall macroeconomic outlook versus a structural shift in the crude market?
I think that the main driver right now is the structural shift in the Chinese economy from industrialization to more service. And then the other is a cyclical factor, is that the global economy is slowing down. Everyone that we look, from the United States to Germany to China to Japan, things are pointing down for 2025. Are EVs playing a role? For sure, on the margins. But I will point out that the International Energy Agency said a few months ago, a few years ago, that global gasoline demand, which is what is really affected by electric vehicles, have peaked in 2019. Since then, have to say that actually, no, it was growing in 2023, has revised the numbers and is actually projecting even a higher number of a higher demand for gasoline for 2024 and 2025. So yes, EVs are playing a role, but the biggest factor is the structural change in the Chinese economy, with lower industrialization or less role for the industrial side, the manufacturing side, more the service side, and then the cyclical slowdown in across the world, notably in Europe.
Javier, this structural change in China has been going on for the better part of a year, 2 years, even 3 years. Why now? Is it suddenly affecting the supply-demand dynamic in a much more aggressive and visible way?
Well, I think that the main reason is we have to look at the supply side. When you keep oil prices close to $100 for 2.5 years, at some point that supply side catches up, overwhelms the market, and that's where you get the glut. Yes, the demand is slowing down in China, but if we didn't have that extra supply coming from the United States, from Canada, from Brazil, from other parts of the world, that would not be a major problem.
So, Javier, how does OPEC Plus basically fight the Permian?
Well, there are only two ways that OPEC can react to the current situation. Either they accept that prices need to go down and they just accept that new reality and slow down shale over time with perhaps $60 to $70, and they are prepared for that, which I think is unlikely, or they have to declare a new price war against shale. OPEC has fought 2 price wars over the last 10 years, and to say that a third time is not possible, I think it will be ridiculous. I think that we need to plan for the potential that OPEC decides to flood the market again.
Well, after the last price war, I spoke with Prince Abdulaziz and asked him about the nasty divorce he was headed to with some of his OPEC members. They try to talk nice, Javier, in public, but behind the scenes, there's always a lot of issues that unnerve all of the members. Where's the group right now in terms of what they envision for 2025?
I think that the group is really split. Saudi Arabia will like that OPEC restrains production and everyone else restrains production. But when you look at the numbers for production, when you start counting the number of tankers leaving OPEC countries, you see that Iraq is cheating, Kazakhstan is cheating, the United Arab Emirates is cheating, probably one of the biggest cheaters of all. So the Saudis are restraining production while every other member of the organization under quotas is overproducing well above those production levels. And then there are a number of OPEC Plus countries that they are not under production limits for a number of reasons, particularly because they are under sanctions, American sanctions, that they are also increasing production, notably Venezuela and Iran. Iranian production hit the highest in 5.5 years, and that is also overwhelming the market.
Hey, Javier, appreciate the update, sir. Thank you. Some big moves in the last few weeks in the crude market. Javier Blas there of Bloomberg Opinion. Let's take the opportunity to get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Japanese Foreign Minister Yoko Yamakawa has declared her bid to become the country's first female prime minister. She promised to strengthen price relief measures and boost real wages. Kamikawa is the 9th lawmaker and the 2nd female candidate to make a formal run for the ruling party's September 27th leadership vote. Campaigning is set to start today. I want to bring us some live pictures. SpaceX is conducting the first ever commercial spacewalk. So as of about 30 minutes ago, oxygen began flowing into the crew's spacesuits. What you are seeing now is billionaire Jarek Eisenman start to undo the hatch. The cabin is fully depressurized. He will go out onto a tether for about 15-20 minutes to conduct the spacewalk, and then SpaceX engineer Sarah Gillis will follow and exit the Crew Dragon for a similar spacewalk. Now, there's no airlock aboard this cabin, so what they've done up to this point is let all of the air, all the oxygen out of the entire spacecraft, turning the whole thing into an airlock. And then, as you can see, they are starting to open the hatch. But in the meantime, all 4 crew members must wear the new suits, again, because this entire cabin has to act as an airlock. So you can see on the bottom left corner, that is the PSI. In other words, the pressurized cabin, it is at 0, which means that Jared Isaacman, again, the one you see with his hand on the latch, is able to start this. Now, it's not an easy latch to open. It does take a few different processes. You might see Sarah Ellis, who is underneath him at this moment, one of the lead engineers on SpaceX, lend her hand at it as well. So that's exactly what we were waiting for now. 32 minutes in, technically, to the spacewalk. Again, it starts officially when oxygen starts flowing into their suits. So at the moment, John, we are just simply waiting for Jared Isaacman to fully open the hatch. You can see the tether there. He will exit and begin the descent into space.
Danny, I've got no idea how long this process takes, but given that he's just sitting there holding the lid, I'm just waiting for this to happen now. I can't leave these pictures, Bramo.
Well, I mean, honestly, it's really compelling. I'm just sitting here kind of trying to push it up for him or pull it down, whatever happens. You know, there's a real concern here, particularly because they're pretty far away from Earth. They're actually further away from Earth than usual, that they could be susceptible to some sort of solar flare. So they're actually watching the sun very closely because of the radiation exposure. It is, you know, I imagine nerve-wracking if you're sitting there about to go where men have gone before, but not very often, and that potentially could be a lot of problems.
Danny, we've seen a lot of developments on this front over the last few years. Some people have called it a billionaire vanity project. Others have talked about it in greater detail about how it can advance civilization. What is this morning?
This, plain and simple, John, is just testing out these spacesuits. That's really what we're seeing. These are new spacesuits, and again, as I mentioned, the entire crew needs to wear them because there is no oxygen currently on board at all. So I guess in some ways it's SpaceX showing, look, we can develop privately these spacesuits, which are so expensive to put together, which NASA has spent so much time doing. So not even just sort of the scientific advancement, it's SpaceX being able to flex that we can do this too. And you can see there, we're starting to get some more movement onto the hatch. As I explained, this is a really slow process. It's not necessarily easy to open this thing, and they're being very careful with it. But it is new tech just from a private standpoint, John, that they are wearing these suits.
Right now, I'm actually doing research, and I thought that it was interesting. The way that these suits were designed was in part by Elon Musk himself and also by someone who has worked with Hollywood to actually design some of the sci-fi aspects of this. How much is this a sort of design aspect, and how much is this actually SpaceX trying to, Danny, rival what NASA is capable of, given the sort of complex, the military and industrial complex behind it, that a lot of people are wondering whether there is the incentive to continue to fund it in the years ahead?
There's definitely an element of both, Lisa, and especially with spacesuits, there had been criticism that they weren't advancing fast enough. Even things like just making spacesuits that can fit women's bodies versus women having to adapt to the spacesuits that are there. But it is a work in tandem. It is SpaceX and NASA together establishing these missions. For example, when you had the rocket separation after the initial takeoff and come back onto the launch pad, part of the reason they had to do it the timing they did is because that very same SpaceX launch pad is getting ready for a NASA mission. So yes, we can say, look, this is SpaceX saying we can do this thing. It's not just you, but it is very clear that it is not SpaceX going at it alone. They are working hand in hand with NASA. But again, in doing a mission like this, the scientific research behind it that they're trying to accomplish is testing these spacesuits and testing spacesuits privately for SpaceX. It's not some sort of bigger, grand NASA-type mission. By the way, you're just looking at the control center now there as they get closer to doing this spacewalk.
Yeah, Danny, you're saying how long this actually takes, but how much time will they have outside this capsule in space?
So Jared Isaacman, again, the billionaire who largely funded this project, will be out there for about 15 to 20 minutes. He then comes back. Then Sarah Ellis, the lead engineer on this mission, will do the same thing. And then the other two people on this mission will stay in the aircraft. Again, I just find this almost heart-wrenching for them because they can't go on the spacewalk, but they have to do all the things that set up for it because there's no oxygen on board. So they are also wearing the spacesuits. So the whole process, maybe from here, we're about 40 minutes in, will take another 30, 40 so minutes as they go out onto that tether.
So, Danny, I think we have to do the compare and contrast. If we sit on what's happening right now with a SpaceX capsule and compare it to what's been happening with Boeing and their efforts in space, there are 2 astronauts stranded in space right now who are meant to be there for days, but will end up being there for months and won't be back until February. Why is SpaceX doing, apparently, seemingly such a much better job on this front than, say, Boeing?
Well, I mean, even just looking at this mission itself, it's going further in space, but also the mission is somewhat different. This thing is just not very long. It's only a couple days, and they didn't bring extra fuel supplies with them. I mean, they're not even prepared for being stuck out in space. Whereas the Boeing trip, not only was it supposed to be 10 days, but it's been extended multiple months. There really is no sort of bandwidth for them to be longer. By the way, I do hear cheering in the control room there. So it does seem like maybe the hatch is open. They're going out. We're not actually seeing the hatch at the moment. There you go. There you can see the hatch is now open. So Jared Isaacman should be shortly exiting the spacecraft at this moment. But John, you're completely right. SpaceX has been able to more successfully do it, and maybe it has something to do with the private backing. The fact that they are taking a billionaire with them who has funded this, and the money behind SpaceX versus Boeing, which is a complicated beast and has so many other aspects that they need to pay attention to, where again they can fly a billionaire who we are about to see exit a spacecraft.
And Danny, we are hearing, as we can see right here, the hatch is open, and this marks the first time that these 4 humans are simultaneously exposed to the vacuum of space before they go out. It does raise this question, Danny, about what the ultimate goal is. How much is this going to be a commercially focused, commercially driven type of enterprise versus basically SpaceX rivaling some of the state-funded space programs to go out?
Yeah, I mean, look, if you could not only sell a seat for people to just experience weightlessness, because that's before what we've seen in sort of the commercial aspects as we look through the very lens of Isaacman as he exits the spacecraft. Before, what you could essentially sell is you go out into space, you go just above the surface, you don't get anywhere near where the moon is, and you can experience weightlessness. What SpaceX is offering here is something very different. They are offering a potential commercial viability to do spacewalks. I mean, that is another level of space tourism. And I think part of what they're selling is we can do this tourism and exploration and scientific research hand in hand. It can all happen together at the same time. But you know, you get this feeling that the people that can actually be offered this is quite a small minority. But again, I mean, these pictures are incredible. You almost have to look at this and what we're seeing, not just as, oh, you know, this is great for science, they're able to fly out there, but almost as a commercial. Look at the kind of advertising SpaceX is getting, saying, hey, if you are a billionaire, we can provide the capability for you to come out and see this very view of Earth.
If you are just joining us, what you're witnessing right now, the first ever commercial spacewalk, a private mission aboard a SpaceX capsule. It's a 4-person crew. And who we see right now exiting that capsule is Jared Isaacman, a billionaire tech CEO. He will ultimately get to have this spacewalk, Lisa, for 10 to 20 minutes, and then we'll see someone else step out, the SpaceX engineer Sarah Gillis, exiting the SpaceX capsule after him. Pretty phenomenal pictures we're getting right now.
They are things that dreams are made of, and something right now as they try to test out these spacesuits that were designed by Elon Musk with the help of others. There is a question here about what the ultimate goal is and how much more successful, as you mentioned, SpaceX has been than Boeing and a lot of the state-sponsored aspects in creating space aircrafts as well as the paraphernalia necessary for that travel.
Danny, wonderful job. Before we let you go, just a final word, please.
I mean, I think the pictures do it all, John. This is quite remarkable. Seeing him come out, he will be tethered. Again, this is a big step for SpaceX, being able to offer this commercially and just a gorgeous view of the Earth.
Danny Berger, thank you. Just phenomenal photos there, Bramo.
I spent a lot of time actually understanding what these spacesuits have to do. They have to pressurize so that your lungs don't boil over from having no pressure whatsoever in space. They need to fully insulate you from radiation. They need to protect you and give you the oxygen to breathe because there is none in space. There are a lot of technical aspects of it, which is why it is a hurdle to cross. At the same time, how do you make it commercial? How do you get there? And this is sort of the first step in that journey.
Well, it's impossible for any normal person to go up there unless you have billions of dollars and go through all this training. But Jonathan, I love the point you brought up about Boeing versus SpaceX. This is a huge feat for Elon Musk, who's up. He's tweeting about it, saying that the Dragon hatch is open and the cabin is now at vacuum zero pressure. And the ability for this individual, a non-astronaut, to go out and have this 15, 20 minutes spacewalk. Pretty incredible, and feels like SpaceX is really ahead of the curve.
We'll continue to monitor some of these pictures and bring you live photos through the next hour or so. Just to tease up the next hour on this programme, just to set things up for you, coming up next, Mohamed, El-Erian of Bloomberg Opinion. We'll catch up with Ed Mills of Raymond James, Eswar Prasad of Cornell University, and Simon French of Panmure Liberum. Plenty going on this morning, 8:30 Eastern Time, jobless claims and PPI. And in 1 hour and 20 minutes, we get an ECB rate decision widely expected to reduce interest rates by 25 basis points.
The actual decision may be less interesting than the press conference. This is often the case, given the fact that Christine Lagarde could be talking about potentially accelerating some of the rate cuts going forward, given how weak some of the growth picture has been, even though they are more focused right now on getting inflation back to 2%.
Let's turn to some of the price action on the S&P 500. We're firmer here by 0.2%, a little bit of a lift after a three-day rally in the equity market. In the bond market, some big moves yesterday post-CPI. Yields ending the day higher by just a basis point, up another 2 basis points this morning to 367.21 on a 10-year maturity. And just to touch in, check base with what's happening with the euro against the US dollar, 110.20. Lisa, firmer by a 1/10%.
Yeah, we'll see if it stays that way after the ECB guidance going forward, given some of the pretty dire prognostications from the likes of Morgan Stanley.
Truly historic morning already here in New York City. Good morning to you all. The second hour of Bloomberg Surveillance up next.
The economy is decelerating. There is a real risk the Fed is falling behind the curve here.
The focus of the Fed has shifted from inflation fear to growth slowdown and recession fear.
The Fed really wants to believe that we're going back to that post-financial crisis, pre-COVID period of exceptionally low levels of interest rates.
Ultimately, what the market needs to see is that the Fed's on a cutting path and that they're cutting towards the 3 handle.
If there's nothing wrong with the economy fundamentally, if it's basically on the right track, you shouldn't have an active policy either way.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now with equity futures just about positive, coming off the back of a 3-day winning streak on the S&P 500. We are higher by a 1/10% on the S&P. On the Nasdaq 100 right now, we look a little something like this. Up a 1/10% on the Nasdaq. On the Russell, some outperformance on the small caps, up by 0.6%. The stage set as follows this morning. 8:15 Eastern Time. We get an ECB rate decision, widely expected to reduce interest rates by 25 basis points. At 8:30, PPI data and initial jobless claims. Then at 8:45, a news conference from the ECB President Christine Lagarde.
I would argue that watching initial jobless claims will be important, and arguably more important for just this morning's actions, maybe listening to what ECB President Christine Lagarde has to say about the forward path for interest rates, given the fact that they're facing a much weaker picture and the fact that a lot of people are baking in either more rate cuts from the Federal Reserve or equal. And that, I think, is going to be a big risk potentially to the euro.
Before we get lost in our problems, a reminder in the last 20 minutes of how small those problems actually are. From space, the first ever commercial spacewalk taking place in the last 10 minutes or so. Some amazing pictures coming in.
You're going to use that for me every single morning. I'm going to start talking about anything. Just remember, from space, you seem really irrelevant. Look, this is actually a really important moment just to understand commercial spacecraft and space exploration, but also because there is this question of the private-public partnership in space at a time where that's an increasing geopolitical risk, as well as just the future of energy and a host of other potential initiatives.
Isaac Min, as he's out there in space, says, looks like a perfect world. Back at home, we still have a lot of work to do, but from here, it looks like a perfect world. Definitely a lot of work to do.
We'll keep sharing some of those pictures for you as they come in from that SpaceX capsule. Live from New York, welcome to the program. Let's start with the price action. Equity futures on the S&P firmer here by a 1/10%. In the bond market, yields are higher by 2 basis points, 367. In Europe, we keep going back to this question. If we've had a big debate about going 25 or 50 at the Federal Reserve, given the economy we have, given the economy they have. Why are we only talking about 25 today?
And what's the potential consequence if they indicate that they are thinking of something more than that later on? Morgan Stanley, you mentioned them earlier. Just a couple days ago, we're talking about the potential for almost parity, a decline of about 7% from here, going down to about 102 versus the dollar, at a time when potentially the ECB has the ability to surprise to the downside in terms of how far they can take their rates.
The euro in and around 110. The lineup this hour looks like this. Coming up, we'll catch up with Mohamed El-Erian of Queen's College, Cambridge, on his outlook for the Federal Reserve, Ed Mills of Raymond James as Harris and Trump return to the campaign trail, and Simon French of Panmure Liberum as the ECB prepares to reduce interest rates once again. We begin with our top story, the latest CPI print boosting expectations for a 25 basis point cut from the Fed next week. Mohamed El-Erian of Queen's College, Cambridge, writing on X that he sees a, quote, anchorless paradigm, one that is crying out for the stabilisation influence that usually comes from a dominant economic narrative rather than the current ping-pong one, and or forward policy guidance as opposed to this era of Fed excessive data dependency. Mohamed has a lot to say and he's with us for the next few hours to say it. Mohamed, good morning to you.
Good morning, John.
Fantastic to catch up with you, sir, particularly your observation yesterday about what's developing in the bond market at the front end of the curve. The swings we saw on the 2-year. Can you share your observations with our audience right now? What was that about?
So we saw a 20 basis points round trip in the 2-year. 20 basis points. That's a lot for that maturity. And we learned two things. One is that we have excessive data point dependence. All that happened yesterday in the inflation report, as people know, is that monthly core came slightly harder than expected. Everything else was aligned, and yet we moved 10 basis points up. And then we discovered a second technical, which is money on the sideline being put to work quickly. And that, I think, is our reality, is that we don't have a dominant economic view, so we get swung all over. But the stabilizer right now is this technical of cash on the sideline. Now, financial conditions are good stabilizers with two very important qualifications. They are volatile, and they have as much perception as reality. So we are going to continue with this volatile world until we restore either a dominant economic paradigm or we restore the power of forward policy guidance.
You could argue that even in the face of all of this volatility, it shows how strong the economic system is, that there wasn't some sort of significant disruption. Isn't that sort of the ultimate stress test, that when the benchmark rate swings around by 20 basis points, you don't see any massive selling? Why is it more pernicious than it might seem on the surface?
So I do think the financial system has been strengthened, and in particular the banks. And we are in a much better place than we were in the past. So you don't get the massive balance sheet effects. You don't get the sort of virtuous cycles, good or bad, that can happen from that. But don't forget that we are the benchmark for the rest of the world. And we cause quite a few spillovers that the rest of the world says, you know what, enough now. We've had enough of this. Please get your act together.
I was surprised at Jackson Hole. To your point, there wasn't more of a discussion, at least not out loud, about what the neutral rate is. Essentially, that sort of paradigm shift that you're looking for, some sort of real discussion of what this Federal Reserve is willing to accept in terms of inflation and a benchmark rate. That said, it sounds like they just don't agree on one. So how can they come up with one if they don't really have that certainty? And frankly, if the market can't agree on one either, is it better just to have one, even if it's wrong?
So, as usual, you're getting me to front-run my Financial Times op-ed tomorrow.
That's what you're here for.
So I think, Lisa, you're absolutely right. But it's not just that we don't know what the destination is. We don't know what the journey is. We don't know what risk mitigation mindset actually means operationally. And also, there's disagreement as how quickly will Fed officials go from backward-looking data dependence to forward-leaning. So we have this disagreement both within the FOMC and also between the market and what seems to be the consensus, if there is one, on the Fed. So this is, for me, it's a fascinating time, but it is also a very confusing time.
So amongst all this confusion, what do you want to hear from Jay Powell next week?
So what I'd like to hear and what I expect to hear is that he's going to cut by 25 basis points. Beyond that, it's more what I'd like to hear than what I expect to hear. I'd like to get a sense of where he thinks the neutral rate is. I'd like to get a sense of where he sees the balance of risks. The market right now has modeled the Fed as a single mandate Fed, maximum employment. Fed officials tell us, no, we're dual mandate Fed. Let's not forget the inflation component. I'd like to know where he is on this.
Do you want to hear more dissent within the Fed?
Yeah, I would like. I mean, I admire the Bank of England. The last decision was 5-4. You had a situation where it was 6-1. I think that's important because that conveys the uncertainty. Yes, they should have more dissent. I think they view dissent as weakness. Most of us view dissent as having really important information content that has to be priced into markets.
I remember a series of votes at the Bank of England, maybe a decade or so ago, I'm sure you remember this too, when the committee was outvoting King. And Governor King was leading the central bank. I think at the time he wanted to increase QE. And you had people on the MPC voting against him. Not only that, there were more people voting against him than voting with him. That's a scenario we don't see at the Federal Reserve. You had a warning coming into the September meeting, and I remember it at the start of summer. You wanted them to reduce interest rates in July, but you acknowledged that the difference between going into September versus July wasn't that great. But you had one fear. If we got one hot CPI print, they might get distracted. Was that what we got yesterday? How distracted might they be?
I don't think that much because it was just one element in a broadly consistent data release that certainly was very close to consensus forecast. But if we had missed on headline, if we had missed on core, if the base effects weren't as favorable as they are right now, you would have seen a total mess in the marketplace. So yeah, that was my concern, is that as much as they don't want to admit it, they are not just data dependent, they're single point data dependent. And that's pretty scary for policy setting.
That's certainly how the market sees it, because it guided the conversation away from 50 and back towards 25. How do you think they'll look to frame this rate cut when they deliver it a week yesterday? Will they call it a mid-cycle adjustment? Will they say it's the beginning of a journey back to neutral, whatever neutral is? How do you think they're going to frame this decision?
I suspect it will be what's called a dovish 25 basis points, which means this is the first of many, and we may be inclined to go even more if the labor market weakens. There was this phrase in the Jackson Hole speech that was really important. We don't want to see the labor market get any weaker. That is a very strong statement from the Fed chair. Whether everybody else is there, we don't know.
Let's say they do what you want, and they come out, they say, this is what neutral is, this is our journey, this is our mandate, this is what we're going to do. How much have they lost control of the plot anyway? Just simply because there are other factors at play. You think about, for example, fiscal coming out and potentially disrupting things. Think about international investment with an auction that's necessarily negative, that kind of forces their hand. How much do they have ability to set the narrative with such a prescriptive tone right now?
So they certainly should be incorporating fiscal. They must be doing this. They certainly should be incorporating QT. I mean, we haven't talked about QT. QT is ongoing on that. They certainly should be doing that. And that should be reflected in what they say. I hope they're doing this internally. I just think they got so burnt in 2021 because they did take a forward-leaning view and they were completely wrong, that they don't want to make another mistake.
What if they say this is a victimless crime? We're not seeing a problem from this, that essentially they're getting it right and the markets are generally, you hear traders actually say, Ashley Powell's doing a pretty good job. So why should they change it? What would your argument be?
Well, first we'll go back to the amount of volatility we've had in fixed income. It has been unusual, Lisa. Okay.
I know. I watch it every day. We were talking yesterday. It was crazy.
Okay, and that has adverse external effects. It undermines also the credibility of the US as the benchmark for many others. And we are in a world in which countries are building little pipes around the US. We don't want to enable that process further. That's the first issue. The second issue is we have a major reconciliation in our future. We have the treasury part of the fixed income market that is signaling quite a high probability of recession. We have the credit part of the fixed income market that is signaling a very high probability of a soft landing. Now, if liquidity doesn't reconcile these two things, there's going to be even more volatility in this marketplace. And at some point, volatility spills back to the real economy. And the only thing keeping this real economy going right now is the labor market.
I'm sitting here laughing because we need to clarify what you said. Market participants that think Powell are doing a great job, they're the bullish ones.
Yes,
Let's be very clear about that.
Correct.
Equities are still near all-time highs.
Yeah.
If we weren't there, I think they'd have something different to say about where we were.
Maybe they're data point dependent as well in terms
their
of
data
their
point
judgment.
is the S&P 500.
Correct.
You mentioned where the bond market is and where markets are and how they're priced. I want to pick up on the amount of demand we've seen for some issuance. We had a gilt issue last week, record order book. had an Italian issue this week, record order book. We've seen a similar dynamic in US high-grade corporate debt in America, particularly last week. 2 very busy days, lots of demand, credit spread stayed very, very tight. Can you reconcile what each part of the fixed income market is telling us right now and whether you can make sense of it?
And we had yesterday a Treasury auction with massive indirect demand. I can only reconcile it by the ton of cash that's on the sideline and the fear that if you don't get into and lock interest rates now, you will lose interest income in the future. So every time we have a backup in rates, people rush back in. I mean, yesterday's dynamic was fascinating for me. The speed of the round trip was significant.
We've seen it a few times in the last week. Mohamed, we're lucky to have you. You're going to stay with us through the ECB rate decision and right up until that ECB news conference a little bit later on this morning. Equities right now are firmer by a little more than 0.1%. Let's take the opportunity to get you an update on stories elsewhere. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. The family behind luxury brand Chanel and the billionaire heiress of L'Oreal have bought a stake in the fashion label The Row, founded by the Olsen twins. People familiar say the Wertheimer brothers have bought a minority stake in the fashion brand. Other investors are also likely to join the deal, which values The Row at about $1 billion. The Row was started in 2006 by sisters Mary-Kate and Ashley Olsen, who had shot to fame as children actresses in the late 80s in the sitcom Full House. General Mills agreeing to sell its North American yogurt business for $2.1 billion. The New York firm will sell U.S. and Canadian operations, including the brand Yoplait, to French dairy companies Groupe Lactalis and Sodial. The proposed transactions are expected to close in 2025, subject to regulatory approvals. General Mills will provide new details in its next earnings report next week. More turbulence could be ahead for Boeing. The plane maker's 33,000 union members are voting today on whether or not to strike when their current contract expires at midnight. The new CEO, Kelly Ortberg, urged members not to strike, warning that a work stoppage could negatively impact recent efforts to turn around the company. And that's your brief, John.
Hey, Danny, thank you. More from Danny in 30 minutes' time. Up next on the programme, returning to the campaign trail.
People start leaving his rallies early out of exhaustion and boredom.
People don't leave my rallies. We have the biggest rallies, the most incredible rallies in the history of politics.
Talking about taking the bait. That conversation up next from New York this morning. Good morning. Equities right now firmer by 0.1% on the S&P 500. In the bond market, yields a little bit higher, up a basis point or two, 367. In 1 hour from now, we'll be very focused on the euro dollar right now, 110.18, just about unchanged. An ECB decision just around the corner. Under surveillance this morning, returning to the campaign trail.
I'm going to actually do something really unusual, and I'm going to invite you to attend one of Donald Trump's rallies, because it's a really interesting thing to watch. People start leaving his rallies early out of exhaustion and boredom.
She said people start leaving. People don't go to her rallies. People don't leave my rallies. We have the biggest rallies, the most incredible rallies in the history of politics. That's because people want to take their country back.
I know you want more of this, so here's the latest. Kamala Harris and Donald Trump, each set to hold rallies today in swing states, with Trump in Arizona and Harris in North Carolina. Ed Mills of Raymond James writing, we expect a near-term bounce towards Harris following the first debate, but the longer-term impact remains unclear. The continued lack of specific policy details may not meet undecided voters' information threshold, and we continue to expect a very close election. Ed joins us now for more. Ed, wonderful to have you back. Welcome back to the programme. We've heard from a lot of people in the past 24 hours who have suggested that a Harris presidency would be good for bonds and perhaps bad for stocks. Is that what your conversations with clients sound like, or does it sound a little bit different?
John, I think at Raymond James, our conversations are much more nuanced than that. We're looking at each specific policy, looking at every sector. What we've done is on every sector of the S&P 500, put out a report and said, here are our top picks in each of these scenarios. Because as we look at stocks, we certainly could see a rally because of the extension of the tax cuts, but a pullback because of an extension of possible tariffs if Trump were to win. With a Harris victory, there would be concern. Are those tax cuts going to end? But not having those trade fights are a really important put and take that a lot of our clients are asking for. And probably one of the biggest parts of the debates are, because the Supreme Court fundamentally altered the way in which we're going to do regulation with a series of cases this year, clients really want to know what can be done with executive action, what requires regulation, and what requires Congress. Those nuanced conversations are much more than one good, other bad.
So, Ed, let's sit on that for a moment. What can be done via the executive branch solely, besides tariffs?
Yeah, Annmarie, so it's tariffs, anything national security related. When we look at the tech export controls, and we got a big headline yesterday that the United States government is going to allow Saudi Arabia to receive certain semiconductors, those are authorities that rest within the executive branch. That does not require Congress, that does not require any kind of long-term regulation. When we look at the Trump policies, leading off what he wants to do are some of those things that don't need Congress, that don't need regulation, and those are the threats next year. The other conversation is we're looking at a Fed cut here. When we're taking that all into consideration, does the uncertainty of one outcome versus another change the path of the Federal Reserve? Another huge kind of conversation with clients at Raymond James.
Ed, I'm intrigued by your notion of, quote, information threshold. What does that information threshold look like?
Well, it's a really good point, because I think that if we would have gone back to 2016 and you had a Hillary Clinton campaign that had a 10-point plan for almost every outcome and was actually kind of won the debates but lost the election, are we looking for that standard? Probably not. But what we do have is a nominee that is relatively new kind of to the American people, despite the fact that she has been vice president. When we look at the polls, it says that there's about a third of undecided voters who are saying, we want to know more about who Kamala Harris is as a candidate, how she would be different than Biden. Because remember, the Biden-Harris administration is pretty unpopular. Right track, wrong track in this country is underwhelmingly, voters say we're on the wrong track. So they probably, for an information threshold, what is she the same, where she's different, what are the tweaks, what is her vision? And I think voters are asking, is this a candidate that I can trust? Is this a candidate that I want to live the next 4 years with as the leader of our country?
As you noted, the conversations you're having with corporate clients are pretty nuanced right now. What are corporate clients actually doing with some of the information that you're giving them? How are they adjusting to the potentially binary outcomes of an election where people have a lot of question marks still?
Yeah, I think that we're trying to make sure that they know that this is an extremely close election. We had the market vote yesterday that they thought this had swung towards Harris. You saw solar stocks up. You saw massive moves in some healthcare names. So I think what they're doing is, if there is a sense that it's moving in one direction or another, they want to thematically be there. And they're also trying to get a sense as to, do they put the trade on now, even though it's imperfect information, or once we get the outcome of this election on November 5th, is that going to be a sell the news event? So it's traditional kind of conversations that you have. I kind of meet with a lot of board of directors with banks. They're trying to get a sense on whether or not right now is the right time to think about M&A opportunities, because that's been completely stagnant. So there are a lot of corporate decisions that are being made now, or getting prepared to be ready to kind of hit that starting gun as soon as they have that outcome known.
Ed, I'd love to know the probability of who's willing to put the trades on now.
Well, it's your traditional hedge funds. It is kind of the faster money in the kind of conversation. But I do think, to that conversation about what can be done with regulation, what can be done with executive order, the kind of final conversation I think is really interesting is, what are some things that happen regardless of the outcome of this election? So regardless of the outcome of the election, we're going to see a major change in which regulation is put on because of the Supreme Court. We think that as we look forward, you are highly probable to get changes to permitting for energy projects. So people are still very optimistic about CapEx spend. Regardless of the outcome of the election, we've had massive fiscal stimulus that has been approved by Congress. 80+% of that money that's been directly approved by Congress has not yet been spent. So that digestion that has to occur regardless of the outcome of the election are good thematic trades that we've been suggesting here at Raymond James.
Ed, thank you, sir. Ed Mills there of Raymond James on the latest. I think we've got to pick up that story on the lack of M&A. It would be borderline idiotic to try and take over someone else in your industry right now and make yourself a target for the campaign for the next 2 months. Who's going to want to do that? Nobody should want to do that right now.
1-800-Nippon-STEEL. I mean, this is essentially what you don't want, right? However, there is a question of whether to lay the groundwork to get some kind of merger done now if you do believe that Lina Khan is no longer going to be at the FTC, or if the next administration is going to be a little bit more amenable to certain tie-ups.
What we do see right now is people laying the groundwork to try to influence both campaigns to not have, at least some of the big donors, to not have Lina Khan stay on, or someone like her potentially in a Trump administration.
Harris is struggling to answer that question. I wish it had come up on the campaign, in the debate in the last few days. I just wish it had come up a little bit more. Hardly touched the subject.
What her vision is in terms of what the competitive landscape should look like and how to achieve that, where M&A falls into that.
Or to borrow a line, got concepts of a plan. It's going to be the new line, right? Concepts of a plan,
I
not
think
a plan.
that was, we haven't talked about that enough.
Concepts of a plan. I've got concepts of a plan for this programme. Up next, we might catch up with Eswar Prasad of Cornell University, joining us to discuss the potential impact of Trump's tariff plans. From New York, this is Bloomberg. Three days of gains on the S&P 500, looking to make that day 4. In 60 minutes from now, we'll have some data for you, PPI and initial jobless claims. Equities at the moment, just a little bit of a lift. You see it on the Russell, the small caps advancing 0.5%. In the bond market, 2-year all over the place. Yesterday, Mohamed's got plenty of reasons as to why. The 2-year yield higher by 2 basis points this morning, 3.66. The 10-year up a single basis point, 3.66.
I'm still thinking about what Mohamed was saying about how the more volatility there is in the U.S. rates market, the more other people create off-ramps for the U.S. Market to try to use that as a benchmark. That's an idea I want to explore a little bit more.
I was about to quote Mohamed, then realised he's still sitting next to us, so to speak for himself. Mohamed, the beginning of the end of U.S. exceptionalism or a risk around U.S. exceptionalism? Which one?
I think a risk around U.S. exceptionalism.
OK. And that's manifesting in the market in what way? In gold as well, and not just in bonds?
I mean, it's manifesting in the fact that the buffers that we've had for the economy, really important buffers, are mostly gone. And now we are income dependent, not just income and balance sheet dependent. We are income dependent, and the most important element of income is labor. I cannot stress how important the labor market is right now.
Well, let's talk about the labor market and what isn't happening over in Europe. I understand it's a single mandate central bank. We're going to talk about euro-dollar, the ECB in the next 45 minutes, a whole lot more. Do you find it odd that we're not talking about bigger rate cuts of the ECB when we're having that conversation about the Federal Reserve?
No, I don't.
Why?
First of all, as you said, it's a single mandate. Second, the behavioral bias is clearly on the inflation side. That is how the DNA is. That's how they react. And then thirdly, it depends which part of the Eurozone you look at for your growth outlook. So if you look at Germany, yes, you would worry. If you look at the periphery, you wouldn't worry. And they are trying to make a policy for an area that's very dispersed right now in terms of economic outcomes.
Yeah, but this is the reason why it's so hard to understand exactly what the outlook for the euro-dollar is. Given the fact that you've got the likes of Morgan Stanley talking about parity, given that the economic outlook is so negative, does it actually do more to attract money to the U.S. to cut rates more aggressively at a time of uncertain inflation outlook? Or does it push people away further because there isn't that clarity that you were talking about the journey and the destination by the Fed? So
we solve in a relative world, not in an absolute world. And because we solve in a relative world, the U.S. will attract capital away from Europe. If we were solving in an absolute world, it would be a different discussion. But that's not what we solve for right now. Capital will go from Europe to the U.S.
The ECB decision, 8:15 Eastern Time. The euro right now, 110.17. Under surveillance this morning, Nippon Steel mounting a last-ditch effort to drum up support for its $14.1 billion takeover of U.S. Steel, sending an executive to Washington for an 11th-hour meeting. The deal still opposed by President Biden, Kamala Harris and Donald Trump, all saying the company should remain American-owned. Can they change that story?
Well, potentially they could change that story. What I'm looking at is when the CFIUS review is over. This is under really a cloud of secrecy, but once that's over, it goes to Biden's desk. Maybe if they think that this deal should actually go through, and I watch how Josh Shapiro acts on this publicly. He hasn't say whether he backs or opposes it, but just that he's talked about how he wants a solution to protect Pennsylvania jobs. When you talk to the union, depends whether you think this deal actually protects jobs or not. Maybe they just need to wait till after the election so this doesn't become political as much.
Yeah, you just have to wonder what the conversations are like. Can you just tell us, after the election, are you guys going to be okay with it?
Exactly.
I mean, that's what I think these conversations are. They're not going to convince them to change their public
I kind of agree with you. They're sort of laying the groundwork for what happens
100%.
afterwards. Let's turn to this story. JP Morgan and Bank of America setting new measures to ease the workloads for its junior bankers. JP Morgan limiting the work week to 80 hours. Bank of America pledging to monitor individual workloads much more closely. The move's coming amid industry-wide debates over whether workloads are too often unhealthy. How this works out in practice is up for debate.
Unhealthy means exceeding 100 hours a week. I was calculating what that means. That means 14 hours a day, all days of the week, 7 days a week, 14 hours a day. You're talking about things exceeding that. Is artificial intelligence going to take over some of this work? I'm serious. Wasn't this supposed to go away with the advent of computers that were brilliant?
When there's live deals, these days can be even longer, by the way. That's like the ceiling outside of live deals. When there's live deals, those days will be longer.
Yeah. I mean, Mohamed, do you think that this is just the days are over? That we're going to actually see this? And that basically this is sort of the last gaps of bragging rights for people who can work this long?
I do think you get peculiar work practices simply because you've got to be seen. I'll never forget, I was flying back with a colleague and we landed at about 4:30 in the afternoon. I remember in California, the day starts really early.
What time did you get out of bed for PIMCO?
At 2:45 every morning.
Every single morning? How long was the day?
I would get to work at about 4:15 till about 6. So that's how long the day was. But I want to tell you, we land 4 o'clock in the afternoon. I ask this person, are you going home? They say no, I'm going to work. I say, but work is in the opposite direction of home. And the answer is yes, but I need to be seen at work.
It's a very American thing, that is. Yeah. Not European at all. Have you noticed that? The FaceTime thing, very, very American.
What's interesting to me is that hasn't changed even post-pandemic.
I think it's changed a bit.
Yeah.
Generationally, it's changing.
Well, people don't want to.
Also, the work from home is changing that.
Don't want to work, is that what you just said?
Well, they don't want to be in the office if they don't have to be, just so that they can be seen.
Good save.
Thanks.
Thank goodness you don't work in a Chinese bank. You seen the latest from over there?
I'd be arrested.
No one's going to want to talk about this, but we should. At least 3 top investment bankers from different securities firms have been detained by Chinese authorities since August. One of them, who used to oversee deal-making at Haitong Securities, fled the country, was arrested overseas about 2 weeks ago before being repatriated back to China in an incident that's widely publicised on state media at the moment. Haitong and other state-backed brokerages recently asked many of their investment bankers to hand in their passports and seek permission for all business and personal travel plans, according to people familiar with the matter. Never mind the work week. Imagine working under those conditions.
They have a capped salary. They have capped compensation. If they travel outside the country, they need permission, and they need to travel with somebody else. A real question here about what Chinese authorities are trying to do. Is this just to prevent graft, as they're saying, and to investigate practices where the state-owned banks have a real clutch over which companies really can do IPOs and access the capital markets? Or is this something else?
This is the latest on the banking industry. Let's get you some better news. New York City renters seeing more relief in August, with rents declining in what's typically the priciest month of the year. The median for new leases down 3.5% from last year, coming in at just over $4,200. That marks the 3rd year-over-year drop in 4 months, signalling a cooling off for the market after a year of record highs in 2023. So if you're about to negotiate with your landlord, present this data to them and tell them that prices are moving in the other direction.
Is that what happened in the Ferro household?
That is what will happen at some point in the next few months.
Can I just say, prices are still 21% higher than in 2019. So let's not whip out the champagne.
Don't encourage the landlords.
But I will just say that there is more turnover. There's more churn. I imagine the moving companies are doing just great. And there is a sense that there is an ability to... I wonder how much this is connected to mortgage rates coming down a bit.
This is my message to everyone, to the people.
To everyone.
Wage growth is still good. Make sure you ask your employer for a pay rise. And the rents are coming down, so make sure you tell your landlord that rents need to come down too. We will make that push together, Lisa.
Can I just say,
things will be a better place.
We talk about Apple, and you always tell me this is deeply personal. We talk about rents, it always gets deeply personal. So I support that. I know, it's great.
It's deeply personal.
All right.
For everyone watching. Turning to politics, Donald Trump's proposed tariffs drawing scrutiny for the potential impact on inflation and the US dollar. Eswar Prasad of Cornell University writing the proposals could, quote, encourage countries to reduce their dependence on the dollar for trade payments. The irony is that using tariffs to punish countries that use unfair trade practices or are trying to reduce their dependence on the dollar is likely to end up hurting the US economy and consumers. The professor joins us now for more. Professor, it's good to see you.
Nice to be here,
First
Jonathan.
question, is there a better way outside of tariffs? Is there a better way?
Depends on what you want to accomplish. If the idea is to protect American jobs, one approach might be to improve U.S. competitiveness and productivity, because that's what's really it's all about. What China has been very effective at doing, despite all the inefficiencies in the economy, is generate economies of scale, particularly in the new technology industries, that are making them very competitive worldwide. So the U.S. needs to think about how it can improve productivity. Now, if you want to control inflation, certainly tariffs are not the way to go, because the notion that tariffs are going to ultimately end up being paid by the Chinese government is completely wrong. Certainly, there are some products where there could be substitutes, where they are not produced by China, they are produced by other countries, and you can substitute away from Chinese imports. But if you think about a broader policy of adopting tariffs to punish countries for anything that they do that the administration does not like, in terms of trade practices, in terms of the use of the dollar and so on, that is really going to have a very negative effect, I think, in terms of what happens with the dollar, what happens with domestic inflation, and I don't think those consequences are going to be positive.
That's why let's stay on this point and let's zoom out a little bit and go back to your notion that countries are looking to reduce their dependence on the US. I have this image that the US is at the core of the system. It cannot be replaced at the core of the system, so other countries are building little pipes around the system. So it still looks like a dollar-denominated system, but the influence is going down over time. If that is the case, if that is a correct characterization, and please fix it if it's not, at what point does this fragmentation change the way the system works?
It's going to have an effect, but it's your right, Mohamed. It's going to be difficult to shift away given the dominance of the dollar in practically every dimension as a medium of exchange, as a unit of account, and as a reserve currency. And the changes are going to be at the margin at most, because these forces feed upon each other. Now, much of the world would like to get away from the dollar, but what we are seeing is a curious phenomenon where the dollar remains very dominant in all of these respects, and in some respects, including payments, it's become slightly more dominant, while there is a great deal of fragmentation in the second tier. So even the euro, which in my view has become a second-tier currency, is sort of duking it out with the Japanese yen, the pound sterling, and the renminbi. On the payment side, there are going to be changes. You know, emerging markets have better payment systems of their own. They have better developed financial markets, so they can more directly trade in their own currencies rather than using the dollar or the euro as a vehicle currency. But here again, what we are seeing is that the share of the other payment currencies like the euro and the yen has come down much more than that of the dollar, and the dollar still remains very important. But there will be changes, and that's going to reduce the efficacy of things like sanctions. So I think we will end up in a system where the dollar is still the most dominant, perhaps a little less dominant than it is right now, and there is a lot more fragmentation, which means there is no serious rival to the dollar.
So do you reject the idea that there will be some sort of incredibly dramatic moment where the U.S. no longer has the privilege of acting recklessly in terms of its borrowing, where suddenly you have this sense that people are really spooked by the volatility in benchmark rates? Are you saying that that will never come to pass just simply because everybody else looks pretty bad too?
In a world that is full of logic, you're correct that we should be seeing a move away from the dollar, given all that the U.S. has done to shoot itself in the foot, the erosion of the institutional framework, Trump threatening that he's going to impose 100% tariffs on countries that try to reduce their dependence on the dollar, the sanctions imposed on many countries that are seen as geopolitical rivals of the U.S., including making it hard for them to use their reserves. They should all be creating a move away from the dollar. But in a world of turmoil, some of it created by the U.S. itself, people look for safety. And then you look for a market that is very broad, that is very liquid, that is very easy to trade in and out of. there really isn't very much out there. And the US very benevolently has been increasing the amount of public debt and therefore increasing the depth and liquidity of that market. So this is a circumstance that is going to be pretty difficult to shift, even though the world dearly wants it.
So if Trump wins, how do you square that? Higher tariffs, but he wants a weaker dollar. Can he have both? No.
Now, that again is an irony, because many of the objectives that Trump has in mind, he wants to accomplish through tariffs, and they're going to have essentially the opposite effect. Because if you impose tariffs across the board, that is certainly going to reduce the amount of cross-border trade, which could almost certainly imply reducing imports. And that is going to mean that the dollar is going to rise because the trade deficit will be somewhat smaller. The financing needs will be somewhat smaller. So you could actually have an appreciation of the dollar. And again, when he talks about, what he's going to do with the dollar, you would think that this should cause people to flee away from dollar assets. But the question again becomes, as Mohamed correctly pointed out, if it's a relative world, you need to find a place to flee to. And there isn't an obvious place to flee to at this stage.
As you know, Professor, there are plenty of reasons to use tariffs to protect domestic industry, to basically say to a country, we're not seeing reciprocity here. This is why we're doing this to you, because you do this to us. There are loads of reasons for tariffs. One is to influence behaviour. And when we hear Donald Trump at the campaign trail, he often talks about influencing the behaviour of the Chinese. And now he's talking about doing it to everyone. If you don't do this, we'll do that to you. It's not just about national security like it is under this administration. How influential can you be with tariffs? If you want to influence behaviour, is it better to use, say, sanctions? When you look at the two options, the two tools, what's more efficient?
Now, again, it depends on the objective. Sanctions have much broader efficacy in terms of making it difficult for countries that have dependence on the dollar, and that's practically every other country, to use that effectively. So in terms of disruption of trade, it's going to help a lot more to use sanctions. Now, tariffs do have the effect of signaling to other countries that American trade policy is going to be very different. Does it really help American industry? What is interesting, of course, is that the tariffs that Trump put in place against China were carried through by the Biden administration, but I think the Biden administration was much more effective in its use of policies against China because it figured out what the real choke point was. China is trying to move into industries that are precisely the industries the US is counting on for a manufacturing revival. The new technology industries, green energy, electric vehicles, and so on. So it is by clamping down on the easy access to chips and technology that it can be much more effective. And that's where I think the Biden administration was more effective than the Trump administration in terms of trying to accomplish the same objective.
I know a book is in the works, so let's continue this conversation. It's wonderful to see you, sir. Thank you. Professor Eswar Prasad there of Cornell University with the line I'm going to use forever now. In a world full of logic, you are correct. Isn't that your favourite line now? It's mine.
Yeah, but, and then there's the but. We are not in a world full of logic. This does not make sense given the fact that we are in a relative world where it doesn't work that way.
In a world full of turmoil. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Just moments ago, SpaceX completed the world's first private spacewalk. It's a process which took about an hour and a half in total. During the outing, billionaire Jared Isaacman and SpaceX engineer Sarah Gillis exited the craft one by one. Once outside, they performed a series of mobility tests in their newly designed spacesuits. The primary goal of this mission was to test SpaceX's new suits. The Polaris Dawn crew confirmed that they are now back in the craft, which you can see. The hatch is now closed and the cabin repressurized. Now they are just doing their final checks for leaks. A government shutdown could be looming. Speaker Mike Johnson pulled a short-term government funding bill from the House just hours before the vote would have taken place. Multiple GOP members said that they would vote against the measure, which included a controversial bill to bar non-citizens from voting in U.S. elections. The government will shut down on October 1st at 12:01 a.m. unless Republicans and Democrats are able to strike a deal. The NFL continues to dominate television, posting record Week 1 viewership this past weekend. An average of 21 million viewers tuned in across all platforms. That's up 12% from last season. These numbers come as millions of TV viewers were unable to watch Monday Night Football, with DirecTV and Disney still in a carriage dispute. Week 2 starts tonight with a Thursday night matchup between the Bills and the Dolphins from Miami. And that's your brief, John.
Danny, thank you. More from Danny in 30 minutes' time. Just got a note from Andrew Honhorst of Citi, who I think published this just for the gentleman to the left of me, Mohamed, called it data over dependence. and said an upside surprise to claims this morning or downside to retail sales next week could still push the Fed back towards a 50 basis point cut. We'll get Mohamed's thoughts on the other side. From New York City, up next on the program, rate cuts just around the corner.
The Fed must be aware that if they go aggressive here, they're in danger of undermining consumer confidence. And honestly, the economy is doing exactly what they wanted to do.
Live from New York, you're watching Bloomberg TV. Equities right now firmer by 0.2%. ECB decision about 40 minutes away, 25 minutes away. This is what we look like. We've got a euro at 110.17. Under surveillance this morning, rate cuts just around the corner.
It's really not a bad economy. It's a good economy, and I don't think it calls for any drastic Fed action. I'd be very happy to see 25 basis points next week. The Fed must be aware that if they go aggressive here, they're in danger of undermining consumer confidence. And honestly, the economy is doing exactly what they wanted to do.
The Federal Reserve goes next week. The ECB goes in about 20 minutes' time. The ECB kicking off a string of central bank decisions at 8:15 Eastern, with the Fed next in line on Wednesday. All economists surveyed by Bloomberg expecting a 25 basis point cut from the ECB. Simon French of Panmure Liberum saying investors assume that some of the structural rigidities of the Eurozone are reflected in slow policy inflections from the ECB. Is the Governing Council going to do anything deliberate to alter the forward curve in September? We suspect not. Simon joins us for more. Simon, welcome back to the programme. A question we've asked all morning. Given the growth backdrop across Europe, particularly in Germany, why are they going 25 today and not 50?
It's an excellent question. If the Federal Reserve have the biggest job, if the Bank of England has the hardest job, I'd say the ECB has got the most interesting job, or perhaps the most complex job, because if you look at the cyclical indicators, particularly out of the Eurozone's biggest economies, Germany and France, you would move on from the debate on what is restrictive and what not is restrictive, which is probably the debate we've had for the last couple of quarters, and say, actually, you probably need to go, and relatively quickly, below restrictiveness into accommodating monetary policy, and try and front-run the Fed, who markets believe, and markets may be wrong, but they believe that the Fed is just far more nimble in responding to those cyclical signs of a slowdown.
Given what you just said about the complexity, if you were Madame Lagarde today, what would you signal about the future, and how would that compare to what the market expects about the future?
Well, I think if her narrative for the last 2 years has been the primacy of inflation fears to the upside, I think she has the vast majority, if not all, of the Governing Council on the idea that that balance of risks has shifted back towards structurally low growth. And I would say that if she gets one message across, she would amplify the importance of not going back to a low growth, a fearful sort of ZERP equilibrium where we get a very poor allocation of capital. And you know her predecessor, his comments earlier in the week, Mario Draghi's comments, will be ringing in her ears around the structural rigidities, the lack of competitive zeal in the Eurozone. And she does not want the Governing Council to be accused of reinforcing that dynamic.
Just to take a cue from the person to my right, what does that mean in terms of the pace of the journey and the destination there for where the ECB rate actually is, given the fact that to not return to zero interest rates or even negative interest rates means that maybe they have to do a little bit more up front?
Yeah, look, I didn't dodge the question, or at least I hope I didn't dodge the question. I would go faster than I expect the ECB to do. And you very kindly put my quote from my notes on as an intro. I don't expect the ECB to try and push down the forward curve. I don't expect them to do anything other than markets expect 25 basis points. But, are we starting to talk about some of the rigidities that we often talk about the Eurozone economy manifesting itself in European Governing Council monetary policy? Yes, I think we are. And therefore, you're starting to talk, aren't you, about a policy mistake of not going quickly enough, given what the data is telling you, which is effectively the softest inflation picture amongst developed markets.
If someone were to ask Christine Lagarde, how do you look at the euro in this sphere? She would say, we don't target the euro. We're not trying to influence the euro. We're just looking at inflation and the dynamism of the region. And everyone says, But how much is that a check on how quickly they can go? What's your view on that? Is that something that pressures them to not move overly aggressively in terms of in comparison with the Federal Reserve, just to protect, make sure it doesn't depreciate too much?
So I think the ECB have been in this cycle for a while, including under a predecessor, Mario Draghi, of saying, look, monetary policy isn't here to solve all the problems of the Eurozone. But the reality is, actually, what we are is seeing sub-trend growth indicators on GDP, on PMIs, business confidence, consumer confidence. That suggests that we are demand deficient across the Eurozone, and that requires a cyclical response. So yes, while she may say, and I understand the intellectual framework that she's operating on, which is monetary policy has to be part of a broader return of competitiveness or re-establishment of competitiveness across the Eurozone, but equally, she's facing cyclical underperformance. That requires quite an aggressive monetary policy response at this stage.
Simon, just want to squeeze a UK question in. Why is the government taking money off pensioners to what they say is to save the market? What's going on in the UK?
Well, they've learned the wrong lesson from the mini-budget of September 2022. They think the gilt market needs to hear about austere behaviour, filling black holes inherited or not inherited from the government. I think that's the wrong lesson from 2 years ago. The right lesson is actually about growth. What was poorly delivered at that point 2 years ago was a growth agenda. The market needs to hear a growth agenda from the Chancellor on the 30th of October. Taking money off pensioners to fill a black hole is not a growth agenda. It's trying to address a bond market fear that I don't think is real. I think it's somewhat imagined.
And fund a big public sector pay rise as well, Simon, which they don't talk about too much anymore. Simon French, thank you, sir, of Panmure Liberum. Big austerity budget may be coming from this government. Who knows? It's going to be painful, apparently.
Yeah, it seems like you have a lot of conviction as to Simon. And
I've got some strong questions, no real thoughts.
Yeah, no thoughts.
Strong questions.
John
ECB decision round the corner from New York. This is Bloomberg.
In equity land, we're mostly pricing in a soft landing circumstance right now.
It's really not a bad economy. It's a good economy, and I don't think it calls for any drastic Fed action.
I don't really care what they do next week. What I care about is how the markets react.
Right now, investors are on edge, and so far it's been a good year. So you could see some people continue to take profits.
For the equity market, volatility is going to dominate because from here, so much good economic news is priced in.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
15 minutes away from an ECB rate decision, 30 minutes away from some important economic data going into the Federal Reserve, a week away. Your scores into all of that look like this. Equity futures just a little bit firmer on the S&P, on the Nasdaq, on a Russell. The small caps outperform up by 0.6%. On the benchmark, the S&P 500 up by 0.2%. Your hour ahead, the next 60 minutes looks like this. 8:15 Eastern Time, an ECB rate decision. 8:30 Eastern, PPI and jobless claims. Lisa, 8:45, a news conference with the ECB president.
It's really interesting to me that somehow in this round-trip volatility experience that we've been having this week, we've settled on the idea that the economy actually is fine after all, and that the Federal Reserve can cut by 25 basis points. The ECB has a bigger struggle, but they're also going to cut by 25 basis points, and everything can keep on going swimmingly along. I do wonder when we get a material shift in the narrative, given how much volatility we've got, and given the fact that people seem to settle on this increasingly with a lot of asterisks around every single one of those points.
Things could change again in the next week or so. So Citi were at 50 for next week. They dropped that down to 25. They're saying they could dial it back up to 50 all over again. And this is the note that dropped 15 minutes ago that I promised you. Data over dependence. The title of this piece from Andrew Holmhorst at Citigroup, and it reads like this. An upside surprise to jobless claims this morning, or downside surprise on retail sales next week, could push the Fed back towards a 50 basis point cut. That language, I know you share it. Data over dependence, Mohamed. Is that a good thing or a really bad thing?
I think it's a really bad thing. I think you have to have a more holistic view of the economy. I'm not sure that a weak jobless claims number or a weak retail sales number would push them to 50 at this point. Okay, so I do think it may push the market to expect a higher probability of 50, but I don't think it pushes the Fed to do 50.
I'm interested in the jobless numbers because UBS's Paul Donovan put this out this morning because a lot of people in the market have been really annoyed with the Labor Department and these massive revisions we've seen. And he says, unlike the employment report, these are accurate as they measure reality, not opinions. But jobless claims do not represent everything, of course, that's happening in the U.S. labor market. But I wonder if people actually look at this and say, these are a little bit more accurate and we can take these numbers a little bit more on hand.
You could get the same data and you could get 5 different opinions by a lot of people in the markets in terms of what you should do with it and what the Fed should do with it, which is the reason why a lot of people are calling for maybe some more visible disagreement among Fed officials so that you can get a sense of how their parameters might be different from one another. There are interesting intellectual arguments to be had. The market's trying to hash it out, and what's really coming to the fore is just unprecedented volatility in some of these benchmark rates.
Totality of the data, 4-week average. 230 on jobless claims. 230, no problem here. Nothing to see here in the labour market, apparently. Is that a decent read on things?
Yeah, I mean, 230 is actually a good number. It's actually an excellent number for this stage of the cycle. What's interesting is what if you get a 250 or 260, or what if you get a 210? So I think plus or minus 20 around 230 makes those numbers really interesting.
Don't you think for market participants the labour market is guilty until proven innocent? And for the Federal Reserve officials, the labour market is innocent until proven guilty. Don't we look at these?
That's a really good way of putting it. That's a really good way of putting it.
That's what it feels like. 210, I feel like in this market right now, they'd be like, whatever. I feel like we're ignoring jobless claims anyway. 4-week average is 230, and we're still freaking out about things. Ally Financials come out. They said credit conditions are bad for auto lending. They're more focused on that than they are on, say, jobless claims.
And that's probably because Federal Reserve Chair Jay Powell himself had the same kind of weighting in terms of they would welcome no further deterioration of the labor market. So does that mean that an additional 20,000 jobless claims could potentially sway them in terms of understanding the trajectory of this market? And I think that's sort of what a lot of people are disagreeing on at a time when everyone's expecting this weakness. The question is just the pace.
Jobless claims, 8:30 Eastern. Let's get you some price action. Equity futures on the S&P 500 still just about positive, up by 0.2%. In the bond market, yields bleeding a little bit higher, up a single basis point. The 10-year 366.46. And going into the ECB, the euro against the dollar, virtually unchanged, 110.15 on that currency pair. Coming up this hour, we'll catch up with Mike Schumacher of Wells Fargo on why the market is still pricing in too much easing. Pooja Kumra of TD Securities saying the ECB is likely to cut by 25 basis points per quarter. And Lindsey Piegza following US jobless claims and PPI data at 8:30. We begin with the big issue. Traders slashing expectations for a half-point cut at the Fed meeting next week. Mike Schumacher of Wells Fargo writing CPI nearly locks in a 25 basis point cut by the Fed on September 18th. The market still prices too much easing. Fade it. The Fed ultimately could deliver even more easing. However, that almost certainly would require a series of downbeat economic numbers over the next 3 months. Mike is with us for more. So, Mike, let's get into it. You say fade it. What are you expecting? How big is the gap between you and market pricing?
It's come in a bit, John. So if you look at the pricing, let's say through the end of the year, the market's got about 100 basis points of easing priced in. Figure 25 next week's pretty much locked. So 75 basis points incrementally. So think about it as a 25 and a 50. I'm not convinced that 50 is done. So the market, in my opinion, should probably move down to call it 90 basis points. I think that would be fair. It's moving the right direction. It's been fairly quick about it, but it's not there yet.
So take us another 6 months where the market is pricing in another 100 basis points of cut. So what do you see the next 12 months look like?
Yeah, it's interesting, Mohamed. So if you think about the next 12 months, the market's priced for what? 225 basis points, 230, something like that. Very much in line with historical cycles. What I think is interesting here, though, is if you look at way out in the forwards and think about the terminal rate, the market's got that about 280. So it's by no means a particularly easy response, if you will. That's still actually above the Fed's long-term target for Fed funds. So it tells me that the odds of a hard landing in the Fed's eyes have tipped higher, but they're not terribly high just yet.
Can you reconcile what you see in what we just talked about with what we see in the credit market and what we see in credit spreads in particular?
Credit has held in incredibly well, in my opinion. I'm surprised default rates have not picked up. I understand it's a bit of a lagging function, but still, we've been waiting for a while. So that's been, I'd say, exceptionally strong, very resilient so far. Demand's been heavy. I think part of that, though, in terms of spreads, not defaults, but shifting over to spreads, is there's been so little carry available in rate markets. In other words, the yield curve has been inverted for so long. Now, if you look at Treasury 2s, 10s, it's flat. I see that. But investors have been forced to go elsewhere to pick up yield, to pick up carry. Consequently, investment-grade credit's benefited. I think that's been one thing helping spreads.
There is this larger question, just to build on what Mohamed was talking about whether different markets are disagreeing with one another, about whether the rates market is talking about recession and pricing in serious weakness, and you're seeing credit markets, you're seeing equity markets really point to ongoing resilience. Do you see it that way?
I think markets can look at different cues for sure, and you've got investors with all sorts of different objectives. But in the end, and maybe that takes a few months to happen, they've got to coalesce around one sort of macro view or one set of macro variables. So at this point, Lisa, it seems to me that market participants are still trying to gauge, is inflation still back in the box? Is it really not something we should worry about too much? And should we shift entirely to the jobs market and growth? I think most people are migrating that way, but they're not entirely there yet. And if the equity market tends to get much more fixated on growth, then you can see a lot of choppiness in some of the high flyers as we've seen recently.
You know, I was struck yesterday when first we got the CPI print. We were surprised that equities actually fell, even as people priced out a 50 basis point rate cut. It should be positive, and I thought that good news was good news. Then we had this wild ride where Nvidia just took over, but I am wondering whether there was any signal there from your perspective.
It did seem to us it was one big trade for quite a while, so the market was locked onto Nvidia, if you will. The correlations were super high. We were looking at various FX pairs. My colleague Jeff Shore tracks it night and day, and you could see high correlations even from FX to Nvidia. It didn't make a tremendous amount of sense. It's faded now, but I'd say for 24, 48 hours, that was the driver.
Mike, before we run, what's the call on the FX market going into this ECB in a few minutes' time?
The ECB is going to deliver not much, frankly, John. And I think as far as FX goes, we think the euro is going to weaken. So take euro dollar down to 108, 107, something like that over the next month or so.
OK, 110.14 on euro dollar right now. Mike, thank you. Mike Schumacher there of Wells Fargo. Just want to pick up on Lisa's point around the CPI print yesterday. Anna Wong of Bloomberg Economics. Reach out to Anna and get some of the research from them, because this quote jumped out for me from the team yesterday. The continued price declines in core goods categories, even as freight costs have risen, suggests firms are having difficulty passing higher input prices onto consumers. That portends further margin compression down the line, with the possibility that firms resort to layoffs to cut costs. The mix in inflation yesterday, problematic for Anna and the team.
You start to look under the hood and you saw that the pop, the sort of one nugget of surprise, came from housing costs that some people say are skewed to the backward looking. A little bit more highlights maybe why this is viewed negatively, why it's too much of a good thing. You want disinflation, but not too much. And that's, I think, what we saw.
Every time you get a backup in yields, those yields get bought pretty quickly, and we saw it repeatedly in yesterday's session. Equity futures right now positive by 0.2%. A little bit of a lift. The ECB rate decision is 5 minutes away. Let's take just a brief moment, an opportunity to get you an update on stories elsewhere. With your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. Unicredit's Andrea Orcel told Bloomberg that a full takeover of Commerce Bank is indeed an option after building a 9% stake. Orcel said he was surprised that the German government was caught off guard by the move, that they had been aware of Unicredit's already existing position when it purchased more shares from the government. Resistance is already building from Germany's powerful unions, while people familiar say Commerce Bank is preparing defensive options. Alaska Air shares higher in the pre-market trade by about 4.8%. The airline boosted its outlook. Alaska also noted lower fuel costs as oil prices drop. It highlighted a stronger than expected month of July thanks to other airlines that couldn't fly during the CrowdStrike disruptions, as well as strong performances in August and September. Experts are watching for signs that Taylor Swift's endorsement of Kamala Harris in the 2024 presidential race could energize millions of her fans to hit the polls in November. The first indication of her influence may come from those who registered to vote at her urging. Swift's custom link to vote.gov drove more than 300,000 visits to the site as of 11 a.m. Wednesday. That's according to the General Services Administration spokesperson. And that's your brief, John.
Danny, thank you. Danny back with us again in 30 minutes' time. Up next on the program, an ECB interest rate decision from New York City. You're watching Bloomberg TV. So the stage is set. 8:30 Eastern, we get jobless claims and PPI. In about 1 minute's time, we get an ECB interest rate decision. And the scores going into all of that look like this. Equity futures on the S&P 500 up by 0.2%, closing yesterday on a 3-day winning streak on the S&P 500 and looking to make it day 4. On the Nasdaq, we just had our biggest day of gains on the Nasdaq 100 since the middle of August. And you can thank Jensen Huang over at NVIDIA. That's the equity market. So we check out the bond market. We look like this in the Treasury market. 2-year, 10-year, 30-year. Lisa, yields up a single basis point. The 2-year, 365.58.
Not necessarily incredibly changed after yesterday's CPI print, with the expectation squarely on the Fed cutting rates by 25 basis points next week.
The 2-year up a single basis point. The 10-year as well to 366.27. And one final look at euro-dollar going into this interest rate decision. Widely expected the ECB to cut by 25 basis points. The euro at 1.1011 and basically unchanged on the session. Waiting for the ECB then, the previous rate on the deposit rate facility was 3.75. The survey, in our survey, we're looking for 3.50. Often they're a little bit late. Waiting for that decision, Lisa, with euro-dollar at 110.16. Still waiting for that that ECB rate decision. Why are they all so late compared to the Federal Reserve?
We now are getting a decision. Frankly, we're getting some other headlines saying that they're going to keep the deposit facility rate. They're going to cut it by 25 basis points to 3.5%. That was the estimate, John.
Waiting for some headlines then and waiting for the statement to come up on the website from the ECB as well. It's good to see the Europeans have got their act together in Frankfurt, Germany, isn't it? Yields are higher by 3 basis points on a 2-year at 2.17. On a German 10-year, up a single basis point to about 2.11. We were looking for 3.50. We got 3.50. The previous rate was 3.75. We're looking for some guidance now, Lisa, from the ECB, and we are looking for some forecasts as well.
Yeah, what is interesting is they're talking about inflation rate, the inflation outlook really determining this, seeing the growth forecast actually as lower for every year through 2026, seeing inflation in 2026, ex-food and energy at 2%. So this isn't necessarily because they see inflation coming down, and seeing next year inflation, just cutting out food and energy, coming out at 2.3% versus 2.2%. So even though they are seeing the growth outlook deteriorating, even though they did cut rates, they still see inflation as stickier over the longer term than on the margins than perhaps they previously thought.
A meeting-by-meeting approach from the European Central Bank versus what we might see from the Federal Reserve next week, where we could get some real guidance about a string of interest rate reductions. The approach from the ECB, very different to what we are expecting from the FOMC.
And commentary like this, they expect to keep rates sufficiently restricted as long as needed, a very different type of commentary than you heard from the Federal Reserve. A question around how much this really does hinge with sticky inflation and the single mandate that this central bank really has.
Let's cross over to Lizzie Burden on the ground in Frankfurt, Germany at ECB HQ. Lizzie, your first take this morning, please.
Well, this is exactly what was expected by economists and markets. Another cut from the ECB. The background is that you've got inflation receding. As they say, the economic activity remains subdued in the euro area, the risks around that mounting. But you've also got a focus on the path ahead. So as you point out, the forecast's really interesting here, trimming their forecast for growth, not just this year, but the years ahead. And this is precisely why Jan Hatzius has trimmed his forecast so that he actually sees consecutive cuts at the meetings ahead, not just quarterly, specifying the growth outlook, manufacturing weakness, the weakness in Germany. So that'll be where the questions focus in the press conference, John. Interesting that they haven't changed their inflation forecast. They see it returning to 2% by late 2025. It's still the same there. It'll be interesting to see at the press conference whether Christine Lagarde emphasises the need to react to the growth risks more so than the inflation risks, because that would encourage traders on the outlook ahead. But I expect, as the language is here in the guidance, that she's going to want to keep her options open.
And Lizzie, I want to just build on that, and that was something that John identified. This is very meeting by meeting. This is not necessarily some prescriptive path like the one that we're hearing more from the Federal Reserve or expecting to next week. At what point will you start to get consensus around ECB members that they need to prioritize growth if they do believe, as Goldman Sachs laid out, that the ultimate neutral rate is near 2% and ultimately inflation is going back to that target?
Well, first of all, you've got to agree where the neutral rate is, and by no means do they agree that it's at 2%. There's a whole spectrum from 2 to 3%, and actually the likes of Isabel Schnabel have been saying that it's going to get harder to agree on the Governing Council the closer and closer they get to that rate. It doesn't mean that it's going to be any easier in the near term, but look, there is so much divergence on the Governing Council. Don't be fooled by this decision that they voted for the 25 basis points. There is so much divergence and concern about the risks ahead and where that neutral rate lies.
Lizzie, thank you. Lizzie Burden there of Bloomberg on the ground at ECB HQ in Frankfurt, Germany. This and the outlook. Staff continue to expect a rapid decline in core inflation from 2.9% this year to 2.3% in 2025 and 2% in 2026. There's going to be plenty of questions today about why they still need to take a meeting-by-meeting approach and aren't communicating something a lot more powerful about reducing interest rates further from here.
Especially given the fact that they're cutting growth forecasts for every year through 2026. At a certain point, if they see inflation falling precipitously, even if maybe falling to slightly above where they previously thought next year, why won't they take a more aggressive approach to support growth? And does that mean becoming more of a dual mandate type of central bank akin to what the Fed does?
The euro totally unchanged. Euro dollar right now, 110.16. Mohamed alongside us. Mohamed, your thoughts on this decision?
So let me frame the question slightly differently to everybody around the table. Why is it that they're still worried about sticky inflation if they've revised down their growth projections? I think that is the key issue, and that I hope someone will ask Madame Lagarde about what is it in the inflation outlook that is proving particularly sticky and worrisome for the ECB.
Let's ask Pooja Kumra of TD Securities that question right now. Pooja, welcome to the show. I'm sure you heard that question from Mohamed. Your thoughts on it, please.
Oh, thank you. So, yes, ECB as expected right now. And I think, as you mentioned, this is the key question. If they are seeing inflation to be a target in 2025, why this slow approach? I think from ECB's perspective, the question right now is but basically the wage inflation, and which is actually standing at 5.1%. And this is much above what we have seen in the 2019 level, which was around 2%. So far, Lagarde has always talked about this WPP model, which is wages, productivity, and profit margins. And I think that's where she will be asked, is productivity actually increasing that can help to reduce these wages, which doesn't seem the case right now. So I think, yes, definitely a very key question for Lagarde right now is, if you are seeing inflation at target, why is this 5% wage inflation still being so sticky, and why are they not cutting rates more aggressively?
In your WPP, she will be speaking today in the context of the Draghi report. And the Draghi report basically says, without major policy actions that aim at improving the way the economy functions, there are no productivity gains that can be sustained. Do you agree with that view?
Yes, totally. I think even when you look at the weakness in Germany, it's more of a structural weakness and not a cyclical weakness. So ECB cutting rates does not help German growth. And I think I do agree with Draghi's model on that we do need that investment, that productivity coming from Europe. But we also know that that's a long process that cannot happen in one day. And I think ECB at this stage really needs to think about, do they just go by the survey data, which are basically suggesting that wages will reduce aggressively in 2025-26, or they stick to the current hard data, which tells you that wages are very sticky.
What do you think would happen in markets? And I'm wondering about the market reaction function in addition to the ECB reaction function. What would happen in markets if Christine Lagarde came out and talked about a more aggressive rate-cutting path, particularly at a time where the euro is baking in sort of the Fed and the ECB moving in tandem?
So again, if they tell us more aggressive path, yes, the front-end rallies, we were pricing in 1.5 rate cuts, so possibly going closer to 2. But we also know the time until the October meeting is basically 5 weeks. So there's nothing much that's changing right now from ECB's data perspective. So I think they would have a big downside risk to growth at this meeting, which doesn't seem the case when we read the statement. So I doubt they are going to be very open about the October cut, but what is more likely is ECB sounding more optimistic about reaching the inflation target, especially given the fact that global growth is actually a negative right now across the board, especially when we look at US and China, which means markets should start pricing more cuts and more aggressive form of cuts in 2025 and pull forward this neutral rate, which is around 2%.
Pooja, how difficult is Lagarde's job in the sense that inflation is quite different whether you look at Central Europe or the periphery?
Yeah, no, that is the key issue for ECB. I think when it comes to ECB, they do have to take Europe as an aggregate. So even if German growth is minus 0.3, they still need to actually look at the entire euro growth, which is still above stagnation. So this is a tricky job. As long as financial conditions are sane across the board, which has been the case since 2020, I think ECB will not go country by country, but look at the total target. Because even like when you said, in Europe, wage negotiations work very differently from country to country. So they cannot actually say by October they'll have the right number of wages for the entire euro area. So I think they do need to work more on surveys and Europe as a whole.
Pooja, we've got to leave it there. We appreciate it. Pooja Kumra there of TD Securities following an ECB rate cut of 25 basis points on the deposit facility. We'll hear from the ECB President herself, Christine Lagarde, in about 20 minutes' time. Lisa, the ECB goes 25.
Mohamed asked the key question, which is essentially if they're downgrading growth, why is inflation still a preeminent concern? And I don't have the answer, and maybe Christine Lagarde does.
I'm sure she will. Written down on a sheet of paper that she might read out a few times in this news conference.
100%.
So you're going to be one of them for an hour.
Basically, how can you message nothingness over an hour at a time when people want real answers?
That's the promo for the news conference, 8:45 Eastern on Bloomberg TV. Coming up next, breaking PPI and jobless claims. We'll get reaction from Lindsey Piegza of Stifel and Michael Shaoul from New York. This is Bloomberg. Looking for the economic data to come out on time in about 20 seconds. Here in the United States, looking for jobless claims and PPI. Equity futures going into that. Futures positive 0.25% on the Nasdaq 100, up by 0.2. On the Russell, the small caps up by 0.4. In the bond market, 2-year, 10-year, 30-year. Shaping up as follows. The yield curve just a little bit lower at the front end of the curve by not even a basis point. The 2-year 363.72. On a 10-year yield, we're at 364.96 with your economic data. Let's cross over to Mike McKee. Good morning, Mike.
Good morning, John. Well, if you were betting on a very low jobless claims number, you got it, 230,000. That's barely up from a revised 228 the week before, so no movement really seen there. The PPI comes in up 0.2, a little stronger than expected for the headline, 0.3, also stronger than expected for the core, and 0.3 for food, ex-food, energy, and trade. So all of the PPI numbers a little bit stronger than expected. However, on a base effects reason, the final demand year over year, 1.7%, food and energy, 2.4%. And ex-food, energy, and trade, 3.3%. Basically, all the same as anticipated by economists. The 1.7% is the lowest for the year-over-year headline PPI since February. That's down from 2.2%. So it's sort of an in-line group of economic data this morning, and they basically say to the Fed, go ahead, whatever you want to do.
Which is probably going to be 25 based on what everyone's saying at the moment. Mike, thank you, sir. Before this number, the 4-week moving average on jobless claims, Ian Ligon pointed this out, was 230. And the number this morning is 230. PPI comes in just a little bit hotter than expected, month over month. Like CPI just yesterday, and this is the price action, the price reaction in the market. Equity futures still positive by 0.1% on the S&P. In the bond market, yields inflect just a touch higher, Lisa. At the front end on a 2-year, up just a single basis point.
There were no big surprises here. And I think that the idea that we were talking about earlier about how this market is primed for some sort of the wrong kind of upside surprise and initial jobless claims. And if we don't get it, status quo. Until we get it, it's sort of everything chugging along. And that ultimately was the key number that came out, given that PPI doesn't have that same kind of correlation with some of the key inflation metrics the Fed watches.
Let's get some more reaction to this and cross over to Lindsey Piegza of Stifel. Lindsey, your thoughts on the data this morning, the data yesterday this morning, and how this sets us up for the Federal Reserve next week?
Well, I think coupled with yesterday's hotter than expected read on the core CPI, this morning's slightly hotter than expected read on the PPI, it's not enough to negate the Fed's intentions to open the door for rate cuts next week, but it is a welcomed reminder of the Fed's ongoing focus on inflation, as price stability is not yet met. And with this lingering uncertainty, unevenness in terms of the disinflationary trend, I think this underscores the Fed's need to remain on a very patient, tempered approach as we do embark on this policy pathway back towards neutral. Now, the market has seemingly removed the expectations for a larger, more aggressive 50 basis point cut next week, but I would argue it was never really on the table. If the Fed did take that more aggressive move, I think that would send the wrong signal to investors, or investors would interpret it that incorrectly as the Fed maybe taking an intention to rapidly reverse us back to an accommodative stance. But at this point, with the economy still solid, slowing, but still solid, I think the Fed's intentions is simply to remove policy firming and get us back to a more neutral state in terms of policy.
So, Lindsey, let's go beyond next week. I completely agree with you. The Fed has been stressing to the market we are a dual mandate central bank, and the market has been responding, no, you're not. You're a single mandate central bank, and the employment part is critical. So now that the data has reminded us that they should remain a dual mandate central bank, how do you see the rest of the curve, in particular what's priced in all the way out to September of next year, evolve in the next few weeks?
Well, I do think investors got ahead of themselves, and I think the downward momentum that we've seen on the longer end does have some wiggle room, some room to reverse course, not necessarily push us back to earlier highs that we saw at the start of the year, but certainly gain at least 10, 20 basis points on the 10-year, putting us back into line with a more realistic pathway of the Fed's trajectory back to neutral. Again, I do think a base case is 25 basis point cuts, and not necessarily at every meeting. The Fed is going to remain data dependent, and if we see inflation stumble for back-to-back months, as we saw in yesterday's and today's reading, I think they're very likely and very willing to skip a meeting. And so I do think that, again, the market's expectation for this rapid reduction back to neutral or even falling below the neutral range by mid of next year is well beyond what the Fed is realistically willing to do.
Lindsey, what in the specifics of the inflation data gives you pause about just how much inflation is coming down? In other words, what are the sticky components that you worry most about?
Well, one of the biggest worries is the housing component. And we saw that in yesterday's CPI report, one of the primary drivers of that hotter than expected read. If we continue to see the shelter component rise or rise above expectations, given the sizable weighting that housing has, not just in the CPI, but even in the PCE, that's going to be very difficult for the Fed to maintain a 2% target or achieve that 2% target on a sustainable basis. So housing is one of those very sticky components that we're focused in on. That being said, even when we do strip out housing and we look at one of the more narrow measures of inflation, the supercore, so we're talking core services excluding housing, we still see that that's a read above 4%, so more than double the Fed's intended target. So there are still a number of underlying components and underlying measures that are not yet cooperating quite as much as the Fed would like, as they are nearing, presumably, that first round rate cut next week.
Lindsey, we've got to leave it there. Appreciate it. Lindsey Piegza there of Stifel, waiting for that rate cut, which most people assume will be 25 basis points. Michael Shaoul joins us now of Ion Asset Management. Michael, good morning to you, sir.
Good morning.
Base case at the moment, the Doves won't get their 50. Can they achieve the same outcome by leaning very heavily on the dot plot?
Yeah, I mean, I think we'll probably see a big dispersion in the dot plot. At this week's meeting, I think that's the way that people are going to really say, we think we should be doing more, or we think we should be doing less. And then the sort of third part of this is which way is Jay Powell going to lean when he talks publicly following the meeting? Is he going to be, pointing towards the Doves or more in the middle of the pack?
So 2 follow-up questions immediately. One is, given your expectations of more dispersion, are we right to look at the median, dot or not? And second, isn't it obvious which way Chair Powell is going to lean?
I would probably say no and no. It's really not clear which side is going to really dominate. I think it's not clear exactly who the doves are and who the hawks are. I think Powell sensibly is trying to steer a middle path between both bodies, and I think he's happy to jump ship to the left or the right, depending on what, he's probably the most data-driven part of the Fed.
You think it's unclear what he says, or it's unclear how much they cut by?
Oh, I think he'll be very clear. He'll be very clear that he doesn't know exactly what they're going to do, and he's going to wait until he gets the information to tell him what he should be doing. I mean, I think he's going to be very clear about that. But what the outcome is going to be extremely unclear.
We were talking earlier about how this Federal Reserve doesn't have this sort of overarching framework of the destination and the journey that we have going forward. I wonder if, as an investor, you do. Can you have that clarity if you don't get it for them, with this sort of conviction that the Fed will ultimately follow whatever it is that you're seeing that is not with any extra data that everybody else doesn't have?
No, I think the Fed, all things being equal, is going to start to cut and is going to put us on a path for a gradual easing. But the bigger question in my mind is what's actually happening in the underlying economy. And when you see members of the Fed almost having to make up words to describe it, there's that long piece using the term equipoise. It's a very weird environment. So
I noticed that John Williams has got a thesaurus. I thought the same thing.
Yes, I was impressed. I was going to say equipose is somebody who tries too hard to make a point. Maybe I shouldn't. Anyway, it's a very strange economy because a lot of the strength that we had, a lot of the overheating that we've had has gone away, but it hasn't really been replaced by any obvious weakness. The labour market I haven't seen a labour market like this, with no real underlying growth, no real power to it, and yet absolutely no deterioration. And initial claims yet again this week confirmed that nobody's hiring but nobody's firing. So it's really the way that gets resolved that ultimately matters much more than what the Fed does. The Fed is going to be responsive to that outcome. I don't think it's going to cause it one way or the other.
I'll attempt to be direct then. What are you buying?
I still think precious metals come out here. I think they're the way that you play a policy mistake. I think, if the Fed is a little bit too on the easy side and tries to get ahead of things, I think precious metals really are the winners.
The policy mistake then, just to be very clear, is them easing too much?
Correct.
Interesting. Michael, thank you, sir. Michael Shaoul of Ion Asset Management. Long precious metals.
Two arguments back to back in why inflation is not dead and why you can't discount it, essentially. And even if the Fed does, that is still something that's preeminent in markets.
Is President Lagarde going to make the same argument? 5 minutes' time.
I'm guessing probably not.
Let's see. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Just a quick recap of that ECB decision. They cut their interest rates by a 0.25 percentage point to 3.5%, as expected. The central bank also cut its growth forecast for every year through 2026, noting subdued economic activity. It did keep its inflation outlook unchanged and reiterated that it can't commit to a specific rate path. As you mentioned, John, we're going to hear from President Christine Lagarde in just about 5 minutes. Time. Intel is wrapping up 3 days of meetings where the chipmaker is reviewing its strategy in what's been a dismal year for the company. Bloomberg is reporting that final decisions are not expected at the meeting itself, but eventual options include scaling back multi-billion-dollar factory projects, selling off subsidiaries, or even splitting Intel's core operations into separate companies. Shares of Intel have fallen 60% year to date. And more turbulence could be ahead for Boeing. The plane maker's 33,000 union members are voting today on whether or not to strike when their current contract expires at midnight. New CEO Kelly Ortberg urged members not to strike, warning that a work stoppage could negatively impact recent efforts to turn around the company after a challenging several years. And that's your brief, John.
Danny, thank you. Thanks for this morning. Up next on the programme, an ECB President Lagarde news conference just around the corner. From New York, you're watching Bloomberg TV. So the opening bell, 9:30 Eastern Time, about 45 minutes away. Before we get there, an ECB news conference with Christine Lagarde begins in about a minute from now. Equities at the moment just about unchanged, a positive 0.1% on the S&P 500. Lisa, the 10-year down a basis point, 364. PPI a bit hotter, jobless claims, let's call it in line at 230.
This hasn't really shaken the market's assumption that the Fed is going to be cutting rates pretty aggressively. And I'm just still thinking about what Michael Shaoul said, that essentially this market is mispricing how much inflation has fallen away, especially with some of the hotter than expected prints. I'm watching break-even rates falling to some of the lowest rates we've seen since the end of 2020.
Mohamed, what's your big takeaway this morning? What's the big takeaway for you?
My big takeaway is never insult Italy if you're anywhere near John Ferro.
It's a good one.
That's my big takeaway.
That's the takeaway from earlier in the programme.
That is my big takeaway.
What were your thoughts about how outspoken the Germans have been over the last week or so on all manners of issues?
I am not going to get you.
You brought it up. I don't
Well,
know.
they've been,
Wanted your
they've been
opinion.
outspoken, though, about what Draghi said. Do you think Draghi's plan is good?
No, I think actually Draghi's report is really important, and they should take it really seriously.
What about it is really important? Which piece of it jumps out to you that you think the Europeans really need to follow through on?
Is the recognition that without serious structural reforms, productivity gains are going to prove elusive, growth is going to prove elusive, and the EU is going to have major problems internally if they don't get the act together.
Do you think European corporates have major problems? One thing he talked about in a news conference when he was addressing Parliament, I believe, he talked about how we were killing European companies with regulation. We're killing our own companies. Do you think that message is well received by the continent?
Is it correct? Yes. Is it well received by regulators? Absolutely not. You see this, I find it fascinating, the reaction to an 80-20 AI innovation. The US embraces the 80 and doesn't look at the 20 as much as it should. Europe completely embraces the 20 downside and forgets about the 80 upside.
This was a point Draghi was making on tech.
I'm laughing because essentially you're trying to lead Mohamed to say something negative about the German reaction function to
No, I think
what he's going to say.
He basically said it about the European bureaucracy.
Well,
Sure.
he talked a lot in much more diplomatic terms, but that was sort of what he was trying to get to you.
I wasn't going to ask questions about the difference between sort of Italian culture at banks versus, say, French and German, and why the German Labour representative seems to think they have more in common with the French banks than they do the Italian banks. I wasn't going down that road.
Will you go down the road of AC Milan should be owned by a German?
I think it should be owned by a Frenchman. I know. I said that repeatedly.
Because he wants nice
AC Milan
uniforms.
should be owned by the richest person in Europe. No debate about that. I've got no problem with that at all. As long as they've got deep pockets, Mohamed, I'm not bothered. That should be the same approach to acquisition, shouldn't it?
What?
As long as they've got big plans, great objectives and deep pockets, should you care where they come from?
Well, I just have a question for you. Does that sort of erode some of the Italian spirit of AC Milan?
Are we interviewing me or Christine Lagarde? What's happening this week?
Well, Christine Lagarde, maybe she can weigh in about our no and whether she also sees potential for AC Milan.